Start the webinar now. So, yeah. Hello and welcome to day 3 of this conference on fintech and COVID-19. My name is John Byrne. I'm a research fellow here at the ADBI in Tokyo. This is a joint event with the ADB and the Cambridge Center for Alternative Finance. Today we will be following the same procedure as the first 2 days. So we will have 2 keynote speakers and 3 paper presentations. I will now hand the floor to Dean Sonobe, who will chair the first session, which is our first keynote speaker. Please, Dean Sonobe, go ahead.
Thank you, John. Good morning or good evening. Greetings from Tokyo. Today, we are delighted that our keynote speaker, Dr. Ratna Sahai, is going to provide us with her view on financial inclusion, one of the key issues of our virtual conference over these 3 days. We are very keen about this issue. I think Ratna doesn't need any introduction, as her excellent work is very widely known and greatly appreciated. But let me help exceptional audience who happen not to know her name, so by providing a very brief introduction. Dr. Ratna Sahai is the Deputy Director of the Monetary and the Capital Markets Department of IMF. She leads key policy papers and projects in the areas of monetary policy, exchange rate policy, capital account, financial development, financial inclusion, and gender and finance. She's been she has occupied many important positions of IMF, and she worked with such great people like Stanley Fischer and Michael Mussa and Kenneth Rogoff. So very impressive career. She has published widely in leading journals, as you know, on monetary policy and the financial sector, including financial market spillovers and the financial crisis and inflation, economic growth, fiscal policy, and debt sustainability and transition economies. She has taught at Delhi University, Columbia University, and New York University, and holds a PhD in economics from New York University. So we are very much excited. So Ratna, thank you very much for joining us. You are in Washington, D.C., so it's evening. Thank you very much. So the floor is yours. So please start your presentation.
Thank you very much, Dean Sonobe, for your very kind introduction. I'm very honored and delighted to present at your event. The IMF has been a little late in coming on this topic, but we started working in this area since about 2014. We also collect data. It's called the Financial Access Survey. And of course, our perspective is very much a macroeconomic perspective. So if you allow me, I'm going to put some slides, just share some slides with you. And let me know if you can see my slides.
Yes,
that's good.
We are seeing your slides.
Thank you.
Okay, thank you very much. Okay, so I'm going to, as I said, provide a macroeconomic perspective. This is a culmination of a number of papers that we had worked at the IMF. So the most important aspect, in some sense, is trying to see if there was a relationship between financial inclusion and economic growth. So we put together a data set, cross-country data set, and we divided the country in terms of where do they fall on financial inclusion, which percentile. So we try to see the relationship controlling for several factors, and then looking at what is the impact of increasing financial inclusion on economic growth. So what we found was that as you move from the 25th percentile, a country that moves from the 25th percentile, as it increases financial inclusion and moves to the 75th percentile, the additional impact on growth rises from 0.2% to 2.9%. So that's a really important result, because it tells you that increasing financial inclusion actually benefits everyone. We also looked at the relationship between financial inclusion and inequality. And we did that by looking at economies which had low financial depth, medium financial depth, or high financial depth. And then we did the same experiment by looking at what happens to inequality as you move from the 25th percentile in financial inclusion to the 75th percentile. So there are two key takeaways from here. The first is that independent of the financial depth of countries, if you increase financial inclusion, you decrease inequality as measured by the Gini coefficient. It doesn't matter whether the depth is low, medium, or high. However, when the depth is low, the benefits are even higher. And so that's an important lesson for countries with low economic depth. But as I said, it happens at high depth also. So if, just as an example, if you look at economies with low depth, the Gini coefficient changes from less than 1% to almost 10%, which is really a very big change. So again, increasing financial inclusion is really important because it provides opportunities to wider sections of the population to participate in the formal financial sector, and that helps in reducing inequality. A third aspect that we looked at related to financial stability. As you all well know, that the 2008 global financial crisis was in some ways related to the objective of financial inclusion in the United States, so that lower income households would have access to mortgages. And that in a way led to a crisis in the US, which then spread to the rest of the world. So if people who are afraid that by increasing financial inclusion, it might destabilize economies, we explored the relationship between high quality regulation and supervision and financial stability. And what we found was, as this chart shows, the green dots show that if your regulation and supervision quality is high as measured by the Basel core principles, bank stability on the y-axis, the higher the number, the greater the stability, you can achieve financial stability even if you increase borrowing by the low-income households or SMEs, for example, if you have high-quality regulation and supervision. On the other hand, if regulation and supervision is of low quality, as you can see in the red dotted line, then indeed it is the case that there would be instability, as we saw in the GFC. So when we looked at financial inclusion around the world, measured by a very simple index, whether you have an account, the percentage of adults who have an account. So in this chart, we looked at shares of males with an account, the financial account, or shares of females with an account. And we just plotted the different countries. And as you can see from the dots, which represent a country, they are all over the map. So many countries have low measures of inclusion, while other countries have high measures of inclusion. But there are two key messages from this chart. So the first is that there is a very wide variation across countries in terms of inclusion measured by percentage of adults with an account at financial institutions. The second message is if you compare men and women, you will see that most of the dots are above the 45-degree line, which means that there are more men with accounts than female. And in other studies, what we have found actually is that the marginal effect on economic growth, as well as reducing inequality, is higher when there is greater female participation in the formal financial sector. So there's a long way to go. So this was with respect to the traditional financial institutions. We then looked at fintech, and we said, okay, let's look at fintech again, measured with a very simple variable, which is access to a mobile phone. It's the same chart as the previous one, which shows the share of males with a mobile phone versus share of females. And again, two aspects are striking. One is that now you see the countries cluttered to the top right column, meaning that more and more countries, fintech is playing an important role in increasing the access to finance to a larger section of the population. But again, similar to the previous chart, what we find here is that men have greater access than women. So let's look at, just comparing two time periods, 2014 to 17, because that's when we got the data for a large sample of countries. And the red bars show the status in 2014, whereas the blue bar in 2017. And what we found was that fintech-driven financial inclusion is rising pretty rapidly across all regions, but it's Africa and Asia Pacific regions that are leading in the adoption of fintech payments. Now, when you look at the inclusion measured from the lending side or credit side, fintech credit side, the left-hand side panel shows you that China clearly dominates the global market for fintech credit. And of course, it's followed by the US and UK, and all other countries are much, much smaller. Now, for the data that we had, what we did notice, as you can see on the right-hand side panel, it is growing very rapidly, even in other parts of the world. And it increased from about 125 billion of US dollars to 400 billion in just a couple of years. However, as a share of total lending, both traditional and fintech is still very, very small. We also looked at whether fintech was closing the gender gaps, because we saw very large gaps. So these bars show you the gaps, the gender gaps. And when we take stock, we find, as you can see from the two bars on the left-hand side, that the gaps are much higher in the traditional sector than in the fintech sector, which means that fintech is actually helping to close the gender gaps. Now, what was really interesting is we found that to be true, mostly in the Middle East and Central Asia and in Africa. However, and I would be very curious to hear from colleagues in this event, why this is so. But in Asia Pacific, the gaps are much lower in the traditional sector than in the fintech sector, similar to Western Hemisphere. This chart basically tells you, again, we had done a study looking at women in leadership positions in financial institutions. And we looked at commercial banks and across different regions. And we were quite shocked to see that the representation of women in bank boards is very low across all the regions. However, it is interestingly the highest in sub-Saharan Africa, followed by European and Central Asian countries. In an ongoing study, what we are finding is that when there are more women in leadership positions, and we're looking at the fintech industry, we also find that the usage by women in both on the payment side as well as on the borrowing side also rises. So for whatever reasons, maybe the women leaders are able to understand the needs of women participants. We find there's a strong correlation actually between women as users of finance and women as leaders of finance. So very briefly, what are the implications of COVID-19? I thought I would touch upon this. Now, what we found that what was quite interesting, that following the SARS epidemic in China, which was in about 2003, because of the social distancing and the need for people to be able to transact remotely, fintech really picked up in China, including e-commerce, of course. In this crisis, what we are finding is that a number of countries around the world, the governments are indeed implementing measures to encourage the use of online facilities in the financial sector. So for example, governments are lowering the fees, increasing limits on digital transactions, and that is helping a lot in keeping the economies going. We think that the fintech and technology can and is playing a huge big role in reducing the economic impact of the COVID-19. And we see that, as I said, in delivering government services, in ensuring continued access to financial services, but also supporting consumption, innovation, and productivity through digital services. So if digital financial inclusion holds so much promise, then we should find ways to encourage it. But we found, there was a study that we conducted in the last 2 years where we combined data analysis along with interviewing stakeholders in several countries. So we interviewed about 70 stakeholders. And this is what we find in terms of constraints. So they said, regulatory uncertainty is a real constraint. This is what the fintech companies are saying, which limits their expansion because they don't know what's going to happen. We also found in all over the world that technological expertise, what we call the coders, there was a shortage of coders, and that was more acute in the emerging markets and low-income countries. Funding was also identified as an issue by the fintech companies. And we were also told that financial and digital literacy creates a hindrance. In many countries, digital infrastructure was a constraint. And then we also found that in many cases, the issue of trust also came up. There were concerns about the future of big tech, and mainly related to whether the industry will remain competitive. And finally, on the lending side, there was still need to understand better what were the legal rights for both borrowers and creditors, and also additional information would be helpful. But of course, as the right-hand panel shows, that fintech usage clearly goes up. For example, if you just take one of these constraints, which is the digital infrastructure, which is not surprising. So before I conclude, I do want to talk about the risks to financial inclusion. So we think there are, even though fintech has great promise, we should worry about financial exclusion. And that can happen when the low-income households or small firms don't have sufficient access to physical and digital infrastructure, when digital and financial literacy is an issue. And I think that the government, in partnership with the private sector, can play a very big role in increasing digital and financial literacy. When I visited several of the fintech firms, I was very pleased to see that many of these fintech firms, in order to increase their business, were actually providing free service, literacy service online on both financial and digital literacy. But that was really small scale. We think that this should be taken up on a very large scale. And incidentally, I should mention that the financial literacy is not just a problem of low-income countries, it's a problem also in advanced economies. Another aspect that we are concerned about is, when machine learning, etc., is used, there may be already biases that are in the historical data that can get even more amplified. So we have to be very watchful that these biases against certain groups or certain minorities are not are removed or mitigated from the start. We are also concerned that in the down cycle, for example, that the fintech companies are hit quite badly, and that could also lead to some pro-cyclicality, extension of credit, and the ones that would be hit more are the lower income households and small firms and women. Then there are also indirect ways in which we find ourselves that there is financial exclusion, and that is if there are microfinance institutions, they might be scaling back much faster than the growth of the fintech industry. There are issues related to data privacy and cyber risks. But I should tell you, in our interviews, we found that in low-income countries or even some emerging markets, data privacy was not as big of an issue as it is in the advanced economies. Cyber risk is a concern everywhere. And then, of course, there are gaps in safety net arrangements, and this is true around the world. So we need to work on the regulatory side. There is need to address safety net arrangements that relate to digital payments and lending. So let me just stop here, and I'll stop sharing my slides, and I'm very happy to answer any questions that you may have. Thank you.
Thank you very much. Thank you very much, Dr. Masahai, for the excellent presentation. Very clear, very deep. So I'd like to invite all the participants to ask questions or make comments. So one in the Q&A box, Amar Yadav, getting the whole economic and monetary transactions on digital platform increases the vulnerability of the nations, of the massive of technological advanced countries. What's your view on the same? I mean, don't you think 100% digital economic transactions is not a good idea? Might be hybrid, let's say 50-50. So this is the first question. And then Paul Vandenberg is raising his hand. Paul, good morning.
Good morning. Do you want me to pose my question?
Yeah, please ask directly.
Okay, thank you. First of all, very nice presentation and interesting statistics. I sort of had just a query about the slide that dealt with financial inclusion and the inequality, the Gini coefficients. Are those sort of just correlations, or do they show us something? I mean, you talked about how moving from this to this increases, decreases inequality. Is that actually what it shows? That shows movements, or it just shows correlations? Thank you. That's all.
Thank you, Paul. So Ratna, please.
Okay, let me go ahead and answer the two questions. So the question from Mr. Yadav on the digital platform, I think the answer to that question is related to part of the study that we had done, which is if you do have very good supervision and regulation, you can have an economy which is highly digitized. But what is really important is for regulation and supervision to keep up with the advances in technology. And if that doesn't happen, then there are, of course, several risks. So the short answer is it can go hand in hand, provided there is good regulation and supervision. And of course, there's also in some areas you need international cooperation, for example, on data privacy, cyber risks. So all those things need to fall into place. On the question by Paul, that's a very good question. These are indeed cross-country regressions, and we control for several factors. So they're not just pure correlations, but what I would say conservatively, they are associations. We do observe it. And you can argue sometimes that it can go the other way, the causality. So I would just like to say that they are associations. This is what we observe in the data across, over 130 odd countries.
Okay. Any other questions? So Ratna, you mentioned gender balance of the board members in the banks, but how about the fintech firms?
So we are just doing that study, actually. I'm glad you asked that question. So in the fintech firms, it is even lower. It's from 10 to 12%. This is what we find globally. But we also find something very interesting. When there are more women in the board of these fintech companies, these companies are attracting more funding and also have higher revenues. So even though that's true, we don't see the number of women increasing.
Oh, I see. Very interesting. Yeah, so unfortunately, the time is coming. So yeah, Ratna, thank you very much for the excellent presentation. And answers to the questions. Very nice. Yeah. So good evening. And
Thank you very much.
Yes, so I'd like to see you again in another event. Thank you very much.
Thank you. Thank you for inviting.
Thank you very much.
Yeah, John, back to you.
Thank you, Dean Sonobe. May I ask everybody who's here, before we move to the next session, to open their video, open their camera. So we will try to do a group photo now for everybody that's here. So yeah, I'll just give them another few moments. Okay, so, okay, still some cameras opening. Okay, very good. Okay, so will one of the staff take the photo? Okay, yes. Okay, so when I say 3, then the photo will be taken and then we will resume the conference. 1, 2, 3. Thank you very much. Okay, so now we will move to the paper session, which will be chaired by Peter Morgan, who's the Vice Chair of Research here at the ADBI. So Peter, over to you.
Okay, thanks very much, John. So this is session 3 on digital financial inclusion, MSMEs, that is micro, small, and medium-sized enterprises, and COVID-19. So in some of the earlier sessions, and certainly in the Dr. Asahi's keynote speech, there's been a discussion of financial inclusion, and this session will really zero in on issues of financial inclusion in these papers. So the first paper is Safety Net and Pandemic, the State of Social Benefit Payments During COVID-19. The presenter is Abu Sean Choi, who's Assistant Professor of Florida International University. And so we'll follow the same format as previously. So 20 minutes for the presentation, then 10 minutes for the discussant, and 10 minutes for Q&A. So Professor Sean Choi, the floor is yours. Also, I'll give you a warning about 3 minutes before the end of your time slot.
No, thank you very much, Peter, for the kind introduction, and thank you very much for including this paper into this conference. May I request for my screen share? Would that be possible for me to share my screen?
Can we share Professor Sanchoy's presentation?
Okay, I think we got
okay.
it.
It's
okay.
done.
Yes, it's,
so thank you. Okay. So the paper that we will be presenting, I'll be presenting, is talking about what happened during the COVID-19 crisis in Bangladesh and how fintech could be a helpful solution to a crisis like pandemic. So this is, I should admit that this is an observational study. So there is no causality, or there is no way we are trying to understand any causal inference from this paper. We wanted to understand the COVID crisis for the safety net benefit payments in Bangladesh. And because some of the benefit payments are being currently delivered using mobile banking or fintech platform, we could compare the traditional banking platform delivery mechanism versus the fintech. So this is where our paper is, but it's a kind of opening a Pandora's box about how situation like in pandemic, how fintech could be very, very helpful. So in Bangladesh, we had a few cases of COVID-19 in the early days. And the first COVID was detected on the 8th of March. And then 18th March, the Bangladesh recorded its first COVID-related fatality. And then in response to the COVID, government imposed a general holiday. Basically in West, we call it lockdown from 26th March to 30th of May. So during this lockdown period, things were pretty much under control. So there was a restriction on the mobility, there were restriction on movement, and we wanted to understand that what will happen to those beneficiaries, those who are dependent on safety net transfers, and try to understand the COVID crisis more or less from the angle of the benefit payments and how they are coping up with this current crisis and what are the conditions of their socioeconomic livelihoods. So in broad sense, what we are trying to understand from this paper is how mobility restriction is affecting vulnerable households in Bangladesh, and with a particular focus on poor safety net beneficiaries. And in terms of safety net beneficiaries, the particular group we are targeting here is old age allowance beneficiaries. We will call them OAA beneficiaries, and widow allowance beneficiaries, WA. And in our survey, which was done, so there was a baseline survey that we have done before COVID, and then this survey was done over telephone. So it was a rapid phone survey. We wanted to focus on two broader aspects of COVID. One is whether financial providers are still operating during the time of pandemic, especially when the lockdown was imposed, and how households who are beneficiaries of safety net payments are coping up during these lockdowns. So just to give you an overview of the findings, we found overall there was a 51% reduction in the medication consumption. So which is a huge number given a large chunk of the beneficiaries are old age allowance beneficiaries. There was a reduction in the medication consumption by 51%. 22% forced to reduce their food consumption during the time of the survey, which was during the lockdown. 41% of the beneficiaries reported not being paid the full benefit amount. However, those who were supposed to receive the benefit amount using fintech platforms, they reported timely transfer and reduction in their vulnerability. So these are kind of the highlight of the results. And so now I'll go into the details. So before I go into the COVID crisis, one important aspect of this research is really taking a step back and trying to understand elderly population in developing countries. So countries like Bangladesh and also India, Pakistan, South Asia broadly will be facing aging and vulnerability in the next decade or so. So I'm giving you some numbers for Bangladesh, and then you can understand that aging will be an issue for Bangladesh, not within a very near future. So number of aged population, 60+ population is about 5% in Bangladesh, and will reach 7% by the end of 2025, according to BBS, Bangladesh Board of Statistics estimations. And Bangladesh is also facing a rising life expectancy. So compared to 2010 to 2013, we have about 3 additional years of life expectancy, which is a very good socioeconomic indicator, but it also tells that we will be having, at least Bangladesh will be having a sizable elderly population in the near future. And currently Bangladesh is one of the top 20 elderly population countries in the world. And if you think about the safety net payment structure or the pension structure, 80% of the elderly in Bangladesh are excluded from any pension support. So these elderly population are largely dependent on their own savings or own arrangements. Sometimes they're dependent on their households or family members, and a big chunk of them are dependent on government support. And there are some recent studies looking into intra-household poverty and intra-household inequality, and it was found that most older people live in absolute poverty. Like even the household itself is not poor to be judged from the income and consumption, but within the household, we will see a disproportionate effect of income and consumption for the elderly population. So it's a rising concern. And I think in next decade or so, we will be seeing more and more research studies talking about the poverty of the elderly population. And in terms of safety net, Bangladesh is one of the leading countries where there are a lot of safety net interventions going on. So not only the safety net transfers are rising, like in 1998, average transfer was 100 taka, 100 local currency, which has now 5 times larger, like about 500 per month. But also government is contributing a fair amount of their national resources for these kind of transfers. So if I give you some numbers, we have in Bangladesh 123 different benefits given to different vulnerable population. The monthly transfer could range from 500 BD taka. So that means that's the lowest amount, but it could rise up to 36,000, which is given to freedom fighters. and it contributes 3% of the GDP, and it also is about 17% of the fiscal budget. Now, the two categories that we'll be talking about, one is the old age allowance. So old age allowance is means tested safety net transfer given by the Ministry of Social Services in Bangladesh. And the eligibility criteria for old age allowance is 65 years of age for male and 62 for female. And the annual income needs to be less than 10,000 BDT. So annual income less than 10,000 BDT is like a really vulnerable condition. And there are some other criteria which are not very important here because these are very hard to detect, but these are the main two indicators for being eligible for the old age allowance. For the widow and deserted and destitute women allowance, there is a minimum age criteria, which is 18 years of age, and the income is 12,000 BDT per year. And less than that, annual income will allow someone to become eligible for these kind of benefits. Now, so in terms of studies, what we wanted to do in 2019, we got a grant to understand the state of social safety net payments in Bangladesh and how digitization could help to help these beneficiaries. So we did a baseline survey in April and August 2019, but we couldn't execute the intervention as planned. It was part of a large randomized control trial with Prime Minister's office in Bangladesh, which is called Access to Information. So because of the COVID, we couldn't do the intervention as planned. What we have done is we conducted a COVID survey with our existing baseline beneficiaries. So we had 7,338 beneficiaries, and nearly half of them from each of these benefit contribution. And we conducted the COVID round from April to May. So what we found, as I mentioned in my highlight, that at the time of the survey, and when we compared the same households before and after, so before, during the baseline and during the COVID round, we found there is a huge difference in terms of their income. So there is a sizable income shock during the COVID lockdown, and there is also, this shock is pretty much homogeneous across different benefit recipients. In terms of coping strategy, we asked them like how you're coping up with this income shortfall. There were two dominant coping strategies. One is cutting down the food consumption, and the second one was cutting down on medication. And cutting down on medication was particularly extremely important for the old age pensioners because a big chunk of their consumption goes for buying medicine. So you can understand the real state of vulnerability for this population. But when we start looking into this data and trying to make a sense, and we also compared that with other national data, what we found that the consumption downfall and the strategy for coping was not as severe as other surveys found. But at that time, BIDS was conducting a survey, BRAC has conducted a survey, and our numbers were much lower than what other surveys found. So we tried to understand that what was happening, why this population were reporting much severe state of their consumption and coping strategy during COVID compared to other national studies. So there might be something that we are missing. So before I go into what was really driving this, I need to explain how the social safety net transfers work in Bangladesh. So the current state of transfer benefits are extremely primitive. So usually what you need to do is, if I'm a recipient of a benefit transfer program, I will have a checkbook, and I don't know when the money will come, and then somebody will tell me that, okay, the money has arrived to your local bank, you need to go there, and then I need to queue up in front of the bank branch for a long period of time. And usually the banks that receive transfer, they will announce that, okay, on the next week for 3 days, we will deliver this amount. So you really need to queue up in front of the bank, and sometimes you need to make multiple trips. And so not only it is extremely time-consuming process to collect the benefits, it is also quite expensive, because if you have to make 2-3 transfers from your home to the bank and go back. So that will also cost you a sizable transaction cost. And also, given the dependent nature of this population, like old elderly population or widowed population, they are very dependent on somebody. So this combination is also very difficult. Like I need to find someone who can help me to receive this money. So this is the current state of transfer payments in the traditional mode. So when we looked into the data that how many of the recipients actually receive money, that receive the last quarter's money, what was striking that about 17% reported that they didn't receive their last quarter's money. And this number is pretty similar across these two benefit transfers. Now the question is, one, why this 17% didn't receive their money? And then also there are a lot of variation because these two groups should be receiving the same amount of money. But we saw that some say 1,500 taka received in the last quarter, some say 3,000 taka, and some say 4,500 taka. So when we start talking with the Department of Social Safety Net, they say that sometimes the banks do not want to operate, like stop their operation to help social safety net payments. So they will accumulate money and they will give it in a big tranche other than distributing on time. So that could have caused these problems. And also the untimely delivery of the safety net payments made some beneficiaries not to receive any money in the last quarter. And so when we're looking into this data, we also know that some of the unions, some of the areas where we are studying, they already implemented a digitized way of transfer payment. So this digitized way of transfer payment is very simple, which is every beneficiary will have like their name entered in the management information system, and there is a biometric authentication. And a beneficiary will have two options to collect the money. Either they can go to the nearby union digital center. So each union, which is the lowest administrative union in Bangladesh, lowest administrative area in Bangladesh, you can go to the union digital center, give your thumbprint, and you can get the money immediately. Or you can sign up for a mobile banking account and the money will come directly to your banking account and you can just cash out visiting an agent. So in this setting, the government is completely bypassing the branch level banking. So the money is directly coming from the treasury to the beneficiary's account. So this is how the G2P is making life much easier for the beneficiaries. It reduces the transaction cost, it reduces the queue time, and also timely delivery. So we wanted to see, like, if in those areas where the payment digitization has already taken place, how they are doing in times of COVID crisis. So I'm just giving you some pictures. So these are union digital centers in many unions, and there are some people, you can just go there. This is kind of a small device where you can give your thumbprint and the money will be given to you. You also have an option to go to like nearby mobile banking agent and you can receive money. So when I look into these numbers, you will see that the number of payment received in various different channels, we see that compared to bank, in the Union Digital Center, people more likely to receive money on time. And this has been reported throughout the survey that those who are in the digitized areas received money on time and they received money the way they were supposed to receive. And because they received the money on time, that also reduced their vulnerability and they had to do less of the coping strategies. So they are cutting down on food consumption was lower, and they are also cutting down on medication was lower compared to those areas where they are receiving money in a status quo situation. We also looked into like bank operation, and we found that some of the banks were not operating during the lockdown, whereas the agents and mobile banking agents were fully operating during that time. We also asked the beneficiaries, like, if you had a choice between traditional bank-based operation versus mobile banking-based operation, which one would you like? And overwhelming majority reported that they would like their benefit transfers to be delivered using mobile banking platform. So since I'm running out of time, just to conclude, so what we found that pandemic-induced lockdown made a substantial dent in income, food, and non-food consumption for safety net beneficiaries. About 18% of the DSS beneficiaries reported not receiving the last quarter's transfer, which is really alarming, and it shows inefficiency and vulnerability of this population. And we found that that digitized areas where the payment could be digitized actually could receive money on time, and that could reduce that vulnerability. So just to highlight two factors here, that in case of crises like this, in pandemic and other bigger crises, it is very important for government to prioritize the timely transfer of the safety net payments for these beneficiaries. And it appears that digitized or fintech-based platform could be a good solution to solve this inefficiencies in the public resource transfer. So with that, I would like to finish my talk. Thank you, Peter.
Okay, thanks very much for a very insightful and interesting presentation. So the discussant is Paul Vandenberg. He's senior economist at ADB, also a former colleague of ours here at ADBI. So Paul, the floor is yours. You have 10 minutes.
Okay, thank you very much, Peter, and very happy to be a discussant on this very interesting paper. And also, of course, thank you, Professor Sonchoi, for the paper and for delivering a very clear presentation. As you know, I've written up some comments I have on the paper, and I don't want to sort of burden us with some technical questions. So I think I'm gonna mention sort of 4 issues, which I think might be important, either for our discussion or to improve the paper. My first comment is actually a positive one. I found the paper very interesting and very enjoyable to read, and for the most part, very clear. And I think those who, like me, are a bit unfamiliar with Social Security payments in Bangladesh will find it very interesting. And it was interesting to see how the government has set up support for widows and for the age. So it's a very interesting paper, parts of it incredibly well written, very clear, and I enjoyed it very much. Just, I don't know if I'm supposed to say positive comments, but anyway, that's what I like. I think the paper, so my second comment is, I think the paper, you know, it talks certainly about Social Security, and it talks about COVID, and that's a big focus of the paper. The fintech part of it, I think, is fairly small. And so it's a great paper to understand COVID and Social Security, but on the fintech side, more could be done. And I wonder if that's something that you might want to develop in the paper. You know, that's the context of the conference and the research that we're doing. So that's, I think, one aspect that could be helped. Point 3, possibly you did a better job of explaining the UDCs and these data centers in the presentation, but in the paper, I was kind of left a little bit still wondering how it all worked and how you could cash out and whether you needed to go in person and so on. I think you explained some of this, that you don't necessarily need to go in person. You can get it directly into a money wallet or a financial account. So I think a little bit of clarity, greater clarity on how that mechanism works, I think will be very helpful, because, you know, that mechanism, the UDC mechanism, is sort of central to what you're trying to explain about using fintech. So I think that could be helpful. My fourth comment, I think, is really my main comment, and it's about sort of some of the results that you get from the survey work. Now, I understand you know, you began your survey work with an initial survey, which was pre-COVID, and then we have COVID, and you're trying to use some initial findings with some updated findings to look at COVID. And I think that's useful, that's helpful, but there are a couple of things that might be improved. First of all, you showed, for example, that about 17% of beneficiaries did not receive a payment, and that was a payment that should have a payment between January 20th and the time of the survey, which I think was April or May, or April through May, it would have been really interesting to know whether normally, non-COVID, what's the level of non-receivement of payment? I mean, is it zero? Is it everyone does actually receive their payment normally in the quarter, and therefore in this case we see that going from 0 non-payments to 17% non-payments? That's not clear, and part of the paper actually says that in normal times beneficiaries often have to wait very long times to get their payments, and it says often weeks, many weeks, so that could run over a quarter. So a comparison between what happened in COVID and what would normally happen might be helpful. I think sort of more of the key question that I have is, or the key suggestion is that when you discuss payments by those who use the UDC system and those who use the linked bank or the traditional system, I'm not always convinced that the comparison is the right one, right? And part of the reason for this is that those using the UDC system, as you explained, this is kind of a pilot that the government started doing before COVID. And I really don't know what the size of the sample that includes the UDC people is. Is it, you said it, I think in the paper it says a fairly small number, but I don't think we have the number. And then taking that small number and aggregating the results and then comparing against the whole sample or the non-UDC sample, I think may get a little bit unbalanced, especially. So I think the idea would be to somehow, have the UDC people, the people who use UDC, and create an appropriate counterfactual or comparison group, okay, so that we could look at both of those groups and look at them as similar groups, instead of taking all the link banked people. And I think that kind of comparison would be good. You might have to talk to some econometricians. I myself can't tell you exactly how to do that. You need to talk to some econometricians to do that. But I think that would be really interesting to do that. So, and just to give you an idea here, we have about 17% who didn't receive a payment, right, or for the whole sample, but of course a lot of people did receive the payment, and then you show that in some cases with the third payment, the people with UDC got more payments than the other people, but I'm not convinced. I'm not convinced that if you expand UDC, you necessarily capture or help those 17%, because there may be other barriers that those people have to getting their payments, whether it's UDC or not. Okay, so they may not have the financial literacy or the technical savvy or the access to the instruments like the phones and so on to actually use the UDC. So it's not clear to me that if you expanded UDC, you would actually deal with the problem. I think I'm going to stop there. And again, I do want to emphasize, I really enjoyed the paper. You've got some really interesting data here, very relevant data, and a very timely topic that we're talking about, which is about financial inclusion and here on the benefits side. So thank you very much.
Okay, excellent comments. Thanks very much. Before we open for Q&A, Abu, would you like to respond to Paul's comments?
Sure. First of all, Paul, thank you very much for your very, very kind comments. I really appreciate those comments, and I pretty much agree with everything that you mentioned. That our paper did not talk much about the fintech part, so maybe we can improve that. The UDC mechanism probably was not written very deeply there. So I just wanted to explain something, which is our main focus was to compare in the digitized area versus non-digitized areas. I understand your concern that what would, because this is not a random selection, so these digitized areas could be just a selection problem, very small sample, and we might need to compare them before and after, like before pre-COVID, whether they are similar or not, and try to understand whether we can create some kind of control mechanism. So we will try to do that. But the problem that we face, as you rightly mentioned, that we have very small statistical power. So there are only 36 unions in 3 districts which were been digitized. So we are still facing that problem of small statistical power. But I mean, it is what it is. We try to kind of deal with whatever limited resources we have in terms of data collection and unsophisticated econometrics there. But all these points are well taken. Thank you very much.
Yes, I have one question. I was just wondering, I was struck by the fact that you mentioned that around 80% of the elderly are not receiving any benefits. And I was just wondering, given that the basic pension the requirements don't seem that strict, and the income of the elderly on the whole is quite low, why isn't there greater coverage of the elderly in these schemes?
I think it's largely the budget constraint. I don't think government has a lot of allocation for safety net. So there is overall allocation, and then also there are differences in the payment structure. So everything that goes under social safety net, that includes the female stipend program that Bangladesh government is famous for, that includes the relief operation during the time of any disaster, and also there is a safety net payment for the elderly. So government is improving it, but it's still not there, not yet to the desired number. So yeah, so it's not covering everyone.
Right. Now we have one question in the chat from Lilis Harry Miss Sisi. Sorry if I can't pronounce it right. Is there any differences between social safety net for older persons before pandemic and during COVID-19 pandemic?
No, they remain the same. So they just continue the same package as they had before the COVID crisis.
Okay, thanks very much. I don't see any other questions at the moment. So
I could have a question.
Okay, go ahead, John.
Yes, thanks very much for your presentation. I'd just like to ask, so basically, did you find any differences in the digital social safety net payment receipts for older people relative to younger people? So I don't know if you covered the differences by age in terms of receiving benefits on time via the digital side.
So because the old age pensioners, they are all 65 and older, right? So one thing we can do is, because the widowed pensioners, there might be some age variation, like they're supposed to be a bit younger by design. So we can look into that. That's a good suggestion, like whether the youngers are much more tech savvy and they can take advantage of it. This is what you're trying to hint?
Yes,
John?
yes.
Okay. Now, point well taken. I'll look into it.
Okay, well, if there are no further questions, let's move on to the second paper.
Thank you.
Which the presenter is Alrina Renita Pinto. She's a rural development specialist at the World Bank. The title is Agent Banking-Led Digital Financial Inclusion for Direct Cash Transfers Through COVID-19 and Beyond, Experience from India. So Ms. Pinto, the floor is yours. You have 20 minutes. Oh, sorry, also, who's going to be presenting, Alrina or Amit?
It's a joint presentation.
Okay, fine. So who's going to start then?
So Amit's going to start. I will share my screen so you can see the presentation.
Okay, so Amit, please start then. And overall, you have 20 minutes.
Sure, thank you. Okay, as it was just told, the presentation is about agent banking-led digital financial inclusion, experience largely from COVID. First few slides would be giving the background. Can you see the slides moving?
Yes.
structure of the presentation, we talk about how the agent-led banking model has evolved in last 10 years or so, leading to extensive financial inclusion, experienced during COVID and way forward. This slide talks about the journey as country we've had in the financial sector, focusing on financial inclusion. The first 50 years or so, until 2005, the focus was government-led banks had rural presence and were opening bank accounts through branches. Just to give you a context, India has about 650,000 villages. Until 2005, we have only about 27,000 bank branches, less than 5%. And opening bank account was a privilege. Public sector banks were only driving credit through government programs. So the level of exclusion, in short, was pretty high. And then 2006, the banking regulator came up with the agent banking model, and things started changing. Initially, not-for-profit entities were allowed and individuals were allowed, but gradually it opened up, and for-profit entities also could provide services under the agent banking model. And somewhere between 2010 and 14, there were a combination of factors which further accelerated financial inclusion. This was one main contributor, as many would know, was setting up a common public good infrastructure in the form of Aadhaar, the unique IDs program, where biometric IDs were issued to almost all Indians. And in parallel, there was a mobile phone-led boom also happening, and government came up with a financial inclusion program commonly known as Jan Dhan, which meant having at least one bank account at the household level, which made to the Guinness Books of Record, because in a very, very short span, about less than a year, 300 million accounts were opened. That's the canvas. Once this public good infrastructure was in place, some ID products were developed to accelerate this further. And the first thing that happened was Aadhaar enabled, that is the biometric enabled payment system, interoperable payment system, which took shape in 2016. This basically allowed any bank's customer to do transaction at any agent. So this has been the trajectory which led to acceleration of inclusion. You'll see in subsequent slides, if you can move on to the next one, how this impacted. So the graph on the left side shows how the number of bank accounts, the basic banking accounts, shot up after 2010, and more significantly so after 2014. That is once the infrastructure was in place, how this has shot up, especially through the agent banking channel, what we call as the BC channel. And this has surpassed the branch channel, in terms of numbers. And the numbers, can be very overwhelming. We're talking of 300 million bank accounts opened in last few years through the agent channel. Likewise, on the right side, you see the bottommost line has been the growth of banking outlets in the form of branches over last 10 years, which is almost horizontal, plateaued. But the growth of outreach, banking outreach through the agent channel, is ever rising up till 2016, and then there is consolidation. But in short, this is more than 10 times growth in outreach in last 10 years vis-a-vis last preceding 50 years. Next slide. So while this has led to tremendous near universal inclusion in terms of bank accounts in last 10 years, there are still significant challenge. And this is the paradox of India. No matter how much you do, there is still more to do. and government has taken very bold initiatives in this in tandem with the regulator. 2017 Global Fintech Survey says we still have the largest unbanked adult population. While this would have reduced in last 2-3 years, in terms of aggregate numbers, this is still big. Inclusion indexes in India, mainly presented by CRISIL, a Standard & Poor company, every 2-3 years, shows while we've made enough penetration in terms of opening accounts, now there are large regional disparities. Developed states, better socioeconomic factors versus underdeveloped states. These are huge disparities, as you see. A state in down south, Kerala, has 90 score, vis-a-vis Bihar, which has 38, and Bihar is among the top 2 most populous states. Second point in this, in terms of exclusion, we need more gender focus, because that's where the gaps are more pronounced, and there are enough literature to show that, and we also examine this in detail as we move forward. Next slide. So again, just to give you an overview of what the agent banking has done, in 2010 we had about 34,000 villages covered through the agent banking network. In 2020, we have 550,000 villages covered through the agent banking network. There are various estimates as to what would be the number of agents, but there is no single point of information which one can rely on, and this is somewhat work in progress. The estimates are we now have about 1 million to 2 million agent networks divided between rural and urban. Again, we don't have an official number of women agents, but one reason for gender gap, this is only a hypothesis at this point of time, could be that female agents are very low, as less as 10 to 12%. Next slide. So public good common infrastructure was in place. Next step, which led to phenomenal rise in banking transactions through the branchless route, assisted branchless route, was the facility of interoperable biometric based transactions, where there was a business case for a bank who was setting up this agent network. So what panned out, and before I explain the graph here, was that using this Aadhaar based infrastructure, a bank who was setting up an agent network could do a transaction through the agent, and the bank who had the customer would have to pay this acquiring bank. So there were 2 types of transactions: honest transaction and offers transactions. Honest means bank has the customer and the agent within its own setup. And offers meant that there was a bank, mostly public sector banks, who had the customer, who had opened the customer's account, but the servicing bank who had put up an agent network could be another bank. And the servicing bank who was servicing the customer through the agent would be paid by the bank who had the customer's account. So the business case for setting up a distribution network was back-end, was not based on the charges which customer had to pay for doing these transactions. The issuer bank would pay the acquirer bank at the back end, which led to phenomenal increase in number of agents who were doing these transactions, and increasingly offers transactions, interoperable transactions, which is what this graph shows. The growth in offers interoperable transactions, largely led by private sector banks setting up this agent network in last 3 years, has multiplied because of this underlying business case. And we have seen, as you will see in the upcoming slides, this has been a lifeline during COVID, where Customers were wary of going to branches. Branches were wary of serving the customers. And this solution, this instrument came very handy. Next slide, I'll ask my colleague Alrina to take over and present from the sample study that we've done in this context. Thank you.
Thanks, Amit. So, jumping right in, given the kind of background that Amit laid out of the financial inclusion context in India, what I'll do in the next couple of slides is illustrate how banking agents stepped up during the COVID-19 lockdown, ensured and were able to ensure that beneficiaries were able to access withdrawal of government relief programs as their social security transfers, and that cash really flowed in the rural economy. So the Indian government, like all other governments, announced a strict lockdown beginning around the 25th of March with restrictions on movement to contain the spread of COVID. All movements were restricted and only essential services were operational. Around on the 26th of March, following that, with the relief package, the Atmanirbhar Bharat COVID-19 relief package that was announced. This had several social safety nets for vulnerable populations. So as part of this package, there was about rupees 500 that would be transferred to women account holders every month for a period of 3 months starting April. During this period, what we see is that BCs were declared as essential services and were able to facilitate withdrawal of these DPT transfers, as well as support basic banking services in the geographies they served. Also, several banks stepped up during this period and provided an additional financial incentive and insurance cover. During this, the 3-month period of DBT withdrawals, what we saw was also just in terms of numbers, 220 million women accounts were credited with the cash relief that was announced by the government. So what we see in the graph here is a spike in the Aadhaar-enabled payments transaction between April and June. This actually corresponds to the period of the DBT transfers and then tapers off starting July. This spike a year appears to correspond with the crediting of DBT transactions into beneficiary accounts. So while this is a macro level trend that we get from data maintained by by the National Payments Corporation of India, there is limited data available at the banking agent level. And what we've tried to do subsequently is break this down using a small sample of data maintained by some of our partner banks. So before we, jump into what some of the findings are, I'll just present a quick background of the sample that we're looking at. It's a very small sample. So really, this is a presentation of some of the, it's a descriptive presentation of the trends that we see. We covered 2 states, Bihar and Odisha. The choice of states is largely coincidental, and we are cognizant of some of the inherent differences that may exist. In case of Bihar, we have a private sector bank where most of the all of the transactions, in fact, performed by the banking agent here are interbank transactions. Whereas in case of Odisha, which is the public sector bank, we have mainly transactions within the same bank or on us. In subsequent slides, we will be presenting only withdrawal transactions. And then a caveat that goes with our data is that there is limited data in the public space. We were able to access this data through a partner bank, and it covers female banking agents. But the findings and recommendations, we've tried to validate wherever possible with some of the macro trends we see and news reports. And the recommendations are more or less broadly applicable to the larger BC ecosystem. So similar to the trends in AEPS transactions that we saw in the previous slide, we see a mirroring effect in our sample. So there is a spike in transactions between the period April to June, which corresponds with the DBT transfers, and this kind of tapers down June onwards. The left side of graph is monthly level aggregates of the transactions. So while you note that Odisha, in Odisha, the number of transactions are much higher compared to Bihar. It's purely from the lower sample size that we see and doesn't have a direct link of productivity of the agents performing this transaction. What we've done on the right side is kind of break down the aggregates over a weekly period. And you see the spikes in these transactions. The peaks actually correspond to the periods of staggered withdrawal. So while the government did announce that cash transfer would be credited to the bank account to bank accounts in April, May, and June, there were periods announced for staggered withdrawal, and the peaks really correspond with that. And then going down to the individual banking agent, what we see at the individual banking agent level is that the trend actually reverses. So while the number of transactions that individual banking agents performed were much higher, the average value of these transactions had dipped during this period. We weren't able to unpack reasons for this because it was administrative data that we're looking at on a smaller set of transactions, but there are possible links to uncertainty associated with the pandemic, as well as constraints in the rural economy. What this means for the individual banking agents is a reduced commission because they reduced revenue because they earn commissions based on the average value of transactions as well. And then moving on is, like all other digital transactions, there is this case of transaction failures. There are several reasons for transaction failures. So biometric reasons in case where the there's a fingerprint mismatch, or the device isn't able to read the beneficiary's biometrics. There are technical reasons in terms of internet connectivity and bank failure issues, so at the back end. And some of the other reasons, is entering of incorrect details. But so what we see during the DBT transfer and withdrawal period is a significant spike in transaction failures. So the transaction failures are much higher for interbank transactions and range from 31 to about 57% during this period. In Odisha, where we have a mix of both interbank and within bank transactions, there's a much lower failure rate of 1 to 3%. And then for the interbank transactions with the public sector unit, the transactions range from about 8 to 11%. While we do not know the exact reasons for the transaction failures, there is a strong pointing to that in case of interbank transactions, the failure rate is much higher. There have been news reports also that corroborate our findings on transaction failures and go to show that some of the failure rates recorded during this period are even as high as 70–80%. And this isn't a new phenomena. So a Financial Inclusion Insights survey of 2018 shows that more than 50% of respondents that had used this channel reported that there were almost similar levels of failure rate.
3 minutes left.
I'm going to pause here and hand over to my colleague Amit. Do you want to come?
Yeah, quickly. Since our sample happened to be of female agents, this was more tangential. We thought we should probe further as to how further inclusion gaps or level of exclusion could be reduced. And we realized that while female customers were more than 50% of account opened, they have limited use cases, and given the biases that are there, how this could be plugged in. So going through literature and past experiences, we find while there have been attempts and with positive results, there is more that needs to be studied. And these are examples of what came out from past experiences and very recent experiences. There is an indication that female agents tend to attract more female customers. And some of our ongoing work using sample data also hints towards that, but it's a little premature to conclude that. Second point is, if you can move to the next slide, is that having female agents may not be enough. We'll have to identify strong use cases that women have and apply those use cases to serve their purpose in the digital context. And we find that one large near universal use case is women-led self-help groups who borrowed about $16–17 billion from banks, but use this money to transact locally in villages in cash. If that opportunity could be digitized to serve the demand side purpose, then the chances of further expanding coverage, especially focusing on women, are pretty high. Next slide. And these are some of our consolidated recommendations / conclusion based on our experience. This is the last slide. COVID showed us that a unit or a department which was a fledgling unit of banks, that is the agent network, and was seen more as a compliance department, became the lifeline. And banks came forward quickly to provide additional support services to agents. To prepare ourselves for better for future, that support needs to be strengthened, be it providing social security or other risk covers to agents, providing them liquidity support, and definitely better commission for passing on DBTs. Second point, as the sample data showed, the transaction failure rate linked to biometrics are very high. So we obviously need to have alternates and backups to the biometric solution, especially if there could be contactless solutions. Fortunately, in India, we've tried iris and some other upcoming technologies, and those effort needs to be accentuated. Second point is there's very little information that is put in public domain to compare the transaction failures and put pressure on banks to improve the quality of service. That would be a helpful measure if taken up. Next point would be more related to the business case. There have been cases where PSU banks seeing large volumes of interoperable transactions, leading to outgo of revenue, the fee cost, have plugged in and stopped transactions on an ad hoc unilateral basis. That needs to be stopped, and there needs to be a stable environment to ensure business cases there. And lastly is the gender part, which we've already spoken. We stopped, once this is in place, I think the focus going forward has to be on more use cases and products and services to encourage further adoption. That's it for now.
Okay, thanks very much. So the discussant is Krishnan Dharmarajan. He's Executive Director of Center for Digital Financial Inclusion. So Mr. Dharmarajan, the floor is yours. You have 10 minutes.
Are you able to see my screen?
Yes.
Yes, we can see it. Thank you.
Okay, thank you so much. Thank you for the opportunity for being a discussant on this. And thanks a lot, Amit and Alrina. It's an excellent presentation and a great idea for research which you have embarked upon and which you have presented here. I'll just summarize quickly, again, some of the things which they said, because some of these points couldn't come out. One is that this paper makes a very strong case to strengthen the BC network, the agent banking network, especially the female banking agents, to expand social protection and reduce the gender gap in financial inclusion. And it assesses the performance and challenges faced by the bank Sakhis in 2 of the states. Bank Sakhis are basically female banking agents who are actually members of self-help groups of women. So it looks at that specific segment of agents and says how the performance was, especially during the benefit transfer period post-lockdown, and makes some very key recommendations. And that's the great thing about this paper. Look both at the very operational level detail and then also source to a very macro level, and tries to give suggestions at very broad policy levels. I really like that about the paper. See, it looks at some key recommendations like making gender-based financial inclusion targets should be set, which go beyond mere opening of bank accounts and specify usage metrics as well. And it calls upon India's central bank, Reserve Bank of India, the Department of Financial Services, to release more granular data on state and bank-wise gender disaggregated account usage. This is very interesting. When you start getting data, you start acting upon it. It's a very good suggestions they have made. Also, it says banks should provide more products and services and better working capital to the banking agents to enable them to offer better service. And this is something that we have found in other research studies, including some which we have conducted, is that working capital is quite inadequate with the BCs. When we did a research, we found that probably 63% of the BCs said they had inadequate working capital to carry out their operations. And the fourth point is the technology and policy measures needed to address the high transaction failure. This is an area which I think the paper went quite deeply into and very interesting when it looked at the incentive mechanism, the interchange rates between private and public sector banks, and how that is affecting the delivery on the ground. So it will need both, there needs to be a policy measure to see how that can be worked out properly, the kind of rates that exist, and also on the technology side. And this is where I think probably we could have gone a bit deeper in the paper or looked at some technology issues, because when you look across states or across banking agents, the technology used many times is not the same. Neither are the local conditions the same. So issues about connectivity, the kind of devices that are used are also could have an impact on the kind of failures which are experienced. It need not necessarily be only economic interchange rates which are impacting this. So probably that could be an area for future research, which Alrina and Amit can carry out. And also mainstreaming use of contactless authentication, which has been suggested. I'll probably come to the challenges on this later. So some specific observations which could look at for future research. What we find is they have quoted a specific study by the Center for Digital Financial Inclusion, and they have given a link to that. It says that more than half the customers of female agents were women. So the CDFI study actually focused on bank Sakhis, which I said are those BCs who are members of self-help groups. So they have, by definition, more female customers, mainly due to the SHGs being their primary clients. They're all women who are the primary clients. But the same study also points out that even the normal banking agents had more number of female customers. Though the percentage may be higher for bank Sakhis, the sheer number of women who are being served by even other banking agents was in fact higher than the individual Sakhis. So therefore, there may be a scope for further research here before any categorical conclusion can be drawn on that. That's something I'd like to point out. Second is the paper refers to project implementation unit data in Bihar. So they've actually looked at backend data and stated that these female agents also had more empathy in providing banking services to elderly and differently abled members of their communities. So here again, the study that we did with the bank Sakhis, the CDFI, showed that normal BCs had in fact significantly higher proportion of elderly and disabled clients. The same study they have quoted is actually shows that. So therefore, here again, we could have, we need to have further research to see whether there actually is an impact on delivery of services to elderly and disabled when you employ female agents. So both are, areas where I think we may need a deeper study. The third observation, there's a specific mention on, the spillover impact of deploying female agents is the digitization of fund flows within the SHG. So the paper, if you see, actually talks about benefit transfers and the use of AEPS, but also says that how all of this is very critical for financial inclusion itself in the last mile. And it says the spillover impact of deploying female agents is the digitization of fund flows. And for the individual, the digitization of these cash flows allows for tracking of transactions and building of a credit history. The availability of credit history associated with formal bank accounts could help women graduate to higher value individual loans, previously inaccessible due to lack of documentation and credit history. What we just need to highlight is that from the tenor which I read in the paper, it seemed as if this is an immediate impending possibility, and this is already there, and therefore this could happen, or this is happening. In fact, one place word also is a decision. So what we need to highlight is that it's a fairly futuristic state, And this would actually require consistent and considerable efforts to realize it on the ground. And the ministry responsible for it and the government of India has been working for quite some time in this direction. But there are still serious concerns over the quality and completeness of even the basic details of members of self-help groups, right? Even their bank account numbers details in many cases are not there. So getting to a granular level financial transaction data is a huge challenge. It's a very huge challenge, and therefore this is it's almost like a wish list what we're talking about here, because these are very huge numbers. As Amit pointed out, in India, whatever is done is huge numbers. So there are huge challenges in making this happen. In fact, the paper states there are 16,000 bank Sakhis, SHG banking agents. There are, now he has updated in the presentation. It says there are 20,000 such agents. But if you look at it, 20,000 bank Sakhi agents, or the female banking agents specifically, to address more than 70 million members of self-help groups alone in the country. So this itself, calls for massive scaling and capacity building at one level. And this has to, and this is only catering to requirements of the self-help groups, which they spoke about as vehicles for financial inclusion. If they were to become agents for the rest of the community also, one can imagine the kind of scaling and the capacity building that has to happen across the country. So therefore, this fact that this challenge and these numbers, say that if you could have indicated that there is a bigger challenge out there, that's something I think the reader of the paper would have been benefited by. So just thought mention that. But then otherwise, the vision that we have painted is perfect, and that's the direction I think the government is also going. Then it also talks about contactless payments and said that upgrading of the AEPS device for iris and face scan. Excellent suggestion. Here again, we just need to have the background that it's a massive enrollment exercise by a country of 1.3 billion. How do you get all those cases with iris and face scans, captured on the field and available for, matching? It's a massive exercise. So it goes far beyond making an AEPS device work. The ramifications of these are much bigger than that. So that's, I just thought I will highlight that part of it. And while the paper recommends SHG AEPS network, we may, I think, should have also probably mentioned there could be other kinds of methods that could be explored here. While AEPS has been a huge success, there could be other alternatives also. And as they also showed some slides, how AEPS itself has grown during the COVID times, I would also like to kind of, we also looked at some public data on that. It's very interesting. It corroborates the kind of position that was placed in the paper, and also gives pointers on where, how we could improve the situation. If you see, I looked at some of this data in the public domain. If you see between the period, 2016 to 2019, AEPS has grown by about 199% CAGR. And the universal payment interface, which is digital transaction, the last mile, it has grown by 788%. Phenomenal across the country. This has grown, right? Interestingly, AEPS, though it has grown fast, it is significantly behind UPI. However, during the COVID times, while all other forms have slowed down, the slowing down in AEPS has been the least. So therefore, this corroborates the fact of how it has played a tremendous role in benefit transfers, which Alrina and Amit's paper also brought out, how AEPS has got a tremendous boost in times, and what a role it has played in benefit transfers through the agents, through an agent banking network in the COVID time. So this growth shows what is happening. And what is also interesting is that this is both in terms of number and value. We find that AEPS is growing. But the third slide I thought is, which I would like to show you, is that while AEPS has grown, it's still a small percentage of the total digital transactions which are happening in the country, and they all use the same base infrastructure at the back. If you see, even during COVID times, which is when AEPS was at the peak at the current times, it's only 3.3% of the total transactions in terms of volume, and 2.6% in terms of value, while the universal payment interface is nearly 46% and 73%. So if we really were to realize, I think somewhere the dream which was projected in the paper of taking digital transactions at the last mile, capturing granular financial transaction details and building a credit history on it for financial inclusion, If we need to build and create that vision, it will be important that we also tap into the other forms of digital transactions on the ground. So probably while AEPS is used for drawing cash and making it maybe an environment for cashless transactions, the last mile driven by mobile payments, mobile-based payments could be a huge boost to financial inclusion. And while we talk about transfer of money, maybe the transfer could be entirely electronic if the usage locally is also electronic. So if we create a digital environment, we could actually leverage a lot more of the growth that is happening. So in future, while we strengthen AEPS, probably we also explore other forms of digital payments in the last mile. And I'll suggest maybe to Alrina and Amit, maybe they could have an experiment, come research around it to see what happens if we have a combination of contactless digital transactions on API combined with AEPS and see if it benefits the people. Thank you again, Alrina, Amit, fantastic presentation. The fact that you threw up the issue on honest and offers transactions and see how it impacted the benefit delivery in the last mile, I think it will go a great way, go a long way in setting right the systems that deliver benefit delivery. Thank you once again.
Okay, thanks very much for excellent comments. Alrina and Amit, would you like to respond to those comments?
Yeah, sure. Thank you, Krishnanji. Very useful insights and inputs, and we tend to agree with all that you said. Only thing I like, the two things I like to highlight: the alternate transaction solution. At least IRIS. Fortunately for India, when Aadhaar was being rolled out, as you'd remember, IRIS was also a part of it. So this would not be starting afresh. Considerable work has already happened. The infrastructure is in place. While definitely I agree, some investments would be required. But now we've reached a stage where this would be left to individual banks to make business case and decide what they want to do. But some alternates options should be on the table. That's the short point. Secondly, the slides you showed in terms of difference between AEPS and UPI, point well taken, but for the benefit of larger audience, who wouldn't have this nuanced detail pertaining to the Indian context, UPI is basically smartphone-led self-service, largely mobile banking services, while AEPS is assisted model, agent network-led model, where I am not savvy enough to use smartphone and link my debit cards and do transaction by myself. I go to the assisted network. So as of now, they seem to be working in different areas, both geographically, which is UPI is largely urban or including semi-urban, while AEPS is rural. And second is the segment who can do transactions by themselves versus the segment who needs help to do transaction from somebody else, in this case, agent. So gradually, UPI will make inroads into the rural space as we build use cases and we bring them into the mainstream fold for sure. But this would also mean that more effort needs to be put in place to ensure customer protection and grievance redressal, because as we get more and more digitally engaged, things like cybercrime and those kind of activities also see a rise, which at least in the rural context, we need to be better prepared. With those enabling factors in place, I completely agree with you. This should be the way forward, and we'll be happy to work more on these areas, be it research or downstream operations, and do pilots to figure out what could be a good balance to move forward. Thank you for your inputs, very useful, and we are also here to answer any questions if there are from the audience. Thank you.
Okay, thanks very much. I have one question. I was struck by the very high percentage of failed transactions. What happens in those cases? Do they retry? Is there let's say some success rate on the second round, or they just stop there?
Go ahead, Alrina.
So it kind of depends on the nature, the reason for the transaction failure. So in case of biometric authentication, so if the fingerprint scanner isn't reading, the BC agent would request the beneficiary to maybe, wash your hands again, clean the scanner, and then try scanning again. So in some cases, after 2 or 3 tries, it may work. In some cases, if it fails at the backend because of either a connectivity issue or a backend banking system issue, the money would still get debited from the beneficiary's account. But because it's a failed transaction, they don't get the cash in hand. So it takes about another 3 to 5 days for the reconciliation to happen and for the beneficiary to then again go and try and perform the transaction. This is actually one of the biggest deterrents for using this network, or is seen as a barrier, because digital literacy in these rural spaces is low. So when their account is debited, it deters them from using this platform. They prefer doing a physical visit to a bank branch. In some cases, there's also incorrect banking details. So for instance, the bank account numbers that are plugged in are wrong. And then the transaction, you're not able to proceed beyond that. So it's quite high. There are being efforts to correct things on, say, biometric and digital literacy awareness that can solve it. But in terms of the infrastructure, there is need for, say, streamlining of backend systems to be able to support the kind of high spike in number of transactions that we saw during COVID.
See, we have one question. Let's see, one. It looks like it's been answered now. So, are there any other questions?
Paul has a
Paul,
question.
yes, Paul. Go ahead, Paul. Paul, you're muted, I think.
Yeah, I was muted. Sorry. First of all, thank you. Very, very interesting presentation. And again, similarities and issues across the 2 presentations, Bangladesh, and in this case, India. My questions kind of follow on a little bit from Peter's about the failures and so on. So on the one hand, we see this huge rise in transactions, and at the same time, we see a lot of failures. And what do you think is the overall impact? Has this experience sort of encouraged people to say, yes, this business correspondent banking is good and useful for me, individuals, or is it that, they tried to do it to get their benefits, but they had these failures, and so it was frustrating, and so they said, well, it's not going to work. I have to go to the bank itself. So overall, has it been a positive experience to push the branchless banking format, or has it had a negative reaction? Thank you.
Overall, Paul, very, very positive experience and impact. Because we need to compare with what was the situation before this came in. 650,000 villages and 27,000 branches. So imagine if I need to interact with banking system, what I need to do: travel miles, spend a day's wage, and still not be sure whether I'll be served well or not. So this has been, a very, very welcome step overall. And the numbers show that, because the transactions are rising by the day. This has given the confidence to the government to pipe DBTs also, the cash transfers, and plug in those leakages. So very clearly, very positive. Having said this, there is operational friction, and this is a learning process. These failure rates are also coming down. Just to give you a specific example, when suddenly during COVID, because of these transfers which happened into 200 million bank accounts, just imagine the number.
Yeah.
The banking system obviously wasn't prepared for this.
Yeah.
So the transaction rose exponentially. So similarly, the failure rates also increased. But then the network switch provider quickly stepped in, and with the banking system huddled together, thanks to the regulator and the policymakers, and they quickly tweaked the system to ensure that the failures rate reduced. So you'll see, while the failure rates were very high in April 2020, when the lockdown announced, Gradually by May and June, this had gone down because, the system responded to the emerging requirement and they tried to plug this in. Overall, very, very positive.
Great, thank you very much. Thank you.
Thank you.
Let's see, we have a question from Joaquin Ray. It says, very interesting paper. What would you say are the biggest challenges for digital financial literacy in India?
Twofold question, I would say. I think it really depends on the geographies that we're looking at. I guess in a lot of the rural spaces, just awareness in general. So there are limited avenues to conduct financial transactions, and then when you move to the digital platform, while there has been a boom in mobile phone penetration, for instance, not everyone has a smartphone that allows them to transact using mobile banking. At the same time, what we've seen is that for women, a lot of this changes drastically. So for instance, women have specific use cases which are not covered as part of main financial or digital literacy programs. So building in both literacy as well as like a use case for populations, I think is one of the bigger challenges we've seen. Amit, would you like to, add in if I've missed out on this?
No, I think that's it. Just to further underline, there's a big difference between urban requirements and rural requirements. So the answer has to be a little more specific to the use cases. But on both sides, having open bank accounts, having set up the public infrastructure in place, now it is for the banks to find those use cases and develop products and services to map that. Generally, banks tend to focus more on short-term gains and service what is actually out there to capture, and then finer things come out in due course. So we're currently going through that phase where gradually more products and services will get developed when these business case gets tapped. That's where we are.
Okay, thanks so much. We're out of time, but it's been excellent discussion. So we'll now take a 20-minute break and reconvene at 12:10 Tokyo time.
Thank you.
Thank you.
Okay. Thank you very much, Peter. This is an ongoing project that we have been working on during this COVID situation. We are trying to assess the impact of COVID on micro, small, and medium enterprises, as well as to understand the recovery process. Me and my colleague Taharin has been working on this project, and a part of the one of the objectives of this project is to look into the adoption of fintech or other online platform by the MSMEs to in their recovery process. Since this is an ongoing project, we are still continuing our surveys. I think we have made some last-minute changes in the slides, so we could not share all latest slides with our discussant, Asami-san. I hope she will understand what we are presenting here. With this, I want to start my presentation. First of all, I want to give you a brief outline of our presentation, the context of this study. As I said, one of the objectives is to assess the impact of COVID-19 on micro, small, and medium enterprises. There have been a lot of studies conducted during this period, but one of the salient feature of our study is that we have done this survey in some industrial states, which are basically especially established for micro, small, and medium enterprises. At the same time, as we also know that fintech and other online platforms have been making a great stride in their recovery process. So we also attempted to see the adoption of fintech by the MSMEs and also their this contribution of fintech and online platform on SMEs recovery process. So our initial target is to get a survey of 200 plus MSMEs, and we have so far until now completed 200, but since COVID has been rising very alarmingly in Bangladesh in these days, so perhaps we have to stop our physical survey. This would be our main sample for this study. The survey, when we finish the analysis or send the slides and paper for this seminar conference, at that time we have completed only 153 forms. So our analysis is mainly based on this 153 forms. We will present some descriptive results as well as some econometric results. Then I will try to make some concluding remarks. Okay, let's come to the survey of the farms. As I mentioned, about 200 farms are surveyed from selected 16 basic, basic means Bangladesh, small and cottage industries corporation industrial estates across Bangladesh. And 16 states means 16 districts, in fact, because one state, one district does the policy of the government, and some districts have a few more states. We follow the same sampling framework that we have used in our previous survey conducted in 2017. So that helped us to make a quick or rapid assessment of the rapid survey of the, during COVID situation. So we took advantage of that survey, and we also use some of the non-time variant factors in the sample or in the analysis. We conduct the survey with a small questionnaire on various aspects of COVID-19 and MSMEs performance, and it was a physical survey, and we sent the enumerators to all the farms, and so it was a bit different than many of the telephone-based surveys. In our survey so far, survey 153 farms, the distribution of farms are as follows: 39% are micro farms, 40% are small. That means almost similar proportion, and medium farms is 21%. As I said, our survey covered almost 16 districts, though the size of the sample is not very big. Since the survey targeted mainly COVID issues, so we have categorized the periods, latter half of the 2020, in 3 periods. So one is lockdown period, which was March 26 to May 30. And then as you see the graphs here, you see that the daily increase rate. So from March 26 to May 31, it was increasing, and then after some time, it started decreasing, and then it remains stable from October to December. So this gives an idea about how to categorize the periods. For example, March 26 to May 30 was the strict lockdown period, and there was no restrictions on mobility, and offices were closed, and everything was there. After that, from June 1st to up to September 30, there was a limited lockdown, in a sense that limited restrictions were on mobility and other things, but still that was a very relaxed situation. From October to December, it was fairly reopened period, and there was no lockdown, no restrictions. So people's made mobility as their wishes, and also farms started their operation almost fully. Based on this, we have collected information for these 3 periods from the farms to assess their impact as well as recovery. Some of the basic findings you can see from here. Sorry. You see that first bar shows the lockdown period, and we have shown in terms of 3 aspects. First one is in terms of production. The orange is representing sales, and the other part is profitability. So 3 basic indicators on which we collect the information. You see that 97% farms production was declined at that time, and also similar sort of farms reported the same because production and sales revenue is the flip side of the coin. But 63% said that their profitability has declined. That means 100% production were not fully stopped. That means some sort of production was ongoing during lockdown also. That's why their profitability has declined to some extent, 60%. As you see over the period, the severity has been declining. That means farms have been recovering to some extent. In the limited lockdown period, about 85% farms reported that their production and sales had declined, and 42 or 43% had reported that their profitability declined. And by the end of December 2020, you see that 74% farms still said that their production was not up to the previous level, in pre-COVID level. And though production, 74% reported that production did not decline, but 82% almost said that their sales declined compared to pre-COVID situation. That means even production geared up, but sales had not geared up because of, I think, demand situation and other problems. So this is the basic picture of the SMEs during the latter half of the 2020s. Then we asked them about the volume of reduction or decline of their production and sales, because previously you see that it was the number of farms that had reported. So you see that in yellow color situation, the first during lockdown, 51% production had declined or decreased for the farms. Those reported their decrease in production, and 30% in limited lockdown period and 21% in without lockdown period. That means farms had recovered almost 80% by the end of December in their production, and also similar in the sales revenue. So this is quite encouraging to some extent for the Bangladeshi farms. And a similar situation you can see in case of profitability. So during lockdown, about 47% in general said their profitability had declined. 47% profitability had declined, but at the end of December, it is 24%. So 50% almost they recovered from the lockdown situation. Okay, then we also collected information on the farms retrenchment of employees because this was a big issue for the small and medium enterprises. You see that during lockdown, 46% farms reported that their workers they had retrenched certain amount of workers, and also maybe similar farms had continued retrenchment of employees at the end of the December. So about 18% or 19%, as we see, that workers are retrenched during the by the end of December. So retrenchment is more in medium and small farms compared to micro farms. So a bit better, larger farms did so to maintain their operations and production process. And now come to the point, our main basic research issues, that what is the status of fintech and online platform use among the MSMEs. As you see that the basic tools that we have considered in this study as a tool of fintech is mobile financial service. So we see that among the surveyed firms, about 23% said that they use MFS for businesses. We particularly asked the question about the businesses. That means it's not a big amount of firm they're using this. And among them, about 63% firms said that MFS transaction has increased during the COVID. And also among those positive response firms, they said that this MFS use facilitated their business during the COVID, about 78%. And in general, we see that they reported that about 38% sales has increased due to use of MFS. So MFS was the only financial techniques or technologies that have been used, I think, very widely during this pandemic, but the limited number of firms had make use of these technologies. Then we also asked them question about the do they have any e-commerce site or online sales? Very small proportion said only 13% of 153 firms said that they have a e-commerce website, and about 10% said that they sell product online, and also the percentage of products sold online is only 1%, about 1%. So this is not very encouraging among the surveyed firms. And what percentage of online sales increased during pandemic? That is, although the firm number is only 4, but they said that there are about 50% sales increase due to online use of online platform. Okay, this is the status of fintech use in MSMEs in our surveyed firms, and then we try to see their impact on recovery process. We usually estimated the recovery by deducting percentage of change in production in the third period minus percentage of change in production in the first period. So we see that those who said that their business transaction through MFS increased during the COVID period, first period, their recovery rate was 50% from lockdown to last phase. And definitely, sorry. And for the recovery rate from lockdown to limited lockdown, the recovery rate was lower than the recovery rate from lockdown to last period by December. Those who said their recovery rate is very low, that means those who are using MFS for their business purposes, their recovery rate was higher. And those even said their transaction remain unchanged, but that means they did some transactions, but their recovery rate even more. So there are some unobserved heterogeneity among the firms in terms of use of MFS. And thus, but in case of e-commerce use and online sales, as you see, the recovery rate almost between these two groups are almost same. That means it's almost insignificant from this apparent observation. So how MFS firms use MFS, or how these MFS can contribute to the recovery process? First of all, when we asked about the use of their MFS in their business, they said that they made payment to raw material suppliers. They also made payment to employees for their salaries, and also they may receive payments from buyers of products. So these are the channels through which MFS contribute to their recovery process. The reason is that, as I said, that the channels reduces transaction cost for the businesses, as well as it helps reduce human touch and infections that might have increased productivity and maintain employability. One more issue is that Bangladesh government declared stimulus packages for the firms during lockdown, and for particularly for textile farms, apparel in farms. One policy was that they can take the stimulus for paying the salaries of the workers through MFS. So the textile and apparel farm, those are even MSMEs, they have used that MFS for paying the salaries to workers that have helped continue their production process. So this is the channel.
3 minutes left.
Yeah, okay. Okay, then since we did not get much of the information about MFS, so we tried to understand the use of MFS in their recovery process through some econometric exercises. So first of all, we checked the determinants of MFS used by the firms. So you see that it's interesting some figure results. First of all, distance to MFS agent was significant, but it is negative. That means lower distance help firms to adopt MFS. At the same time, the period 1, period 2 are significant. That means percentage of production loss is an important determinant to adopt mobile financial service. And second period, it is negative in a sense that the same firm that have used MFS in the first period have used in the second period too. So their recovery is higher, so production is loss is lower in that period. Apart from that, as we mentioned, textile industries showed significant in adopting mobile financial service, and metal farms, we see that others are not found that much significant. So these are the main criteria why farms use this mobile financial service. We have done several types of regressions. First of all, we tried to check the through OLS results. You see that in all those MFS use was found significant, quite significant for the recovery process. And since you know those who are very quite well known about the literature on mobile money and others, you see the use of adoption of mobile money has endogeneity issues, and the vast literature said about this. That's why we use some IB regression results where we use distance to MFS agent and distance to district as an instrument. So instrument variable, and using that instrument variable, we also find that mobile financial technology use has a significant impact on the recovery of the funds. Though our fund number of funds are small in size, it's about 35 or 40 funds, but it still shows that those who have used mobile financial, their recovery rate is faster than other firms that have not used the mobile financial technique. One note of caution here is that since the non-user firms are very large in numbers, one might ask the question about the balancing properties. But still you see that when we do the regression for textile industries, where number of farms at this moment 40 year treatment, if you consider those who received the mobile, who used the mobile financial service 16, and those who did not 24, almost same number of farms, it still shows that mobile financial technique use is very significant on the recovery of the textile farms. So from this results, we can conclude that use of MFS during COVID significantly contributed to recovery of farms. And as I said already, they used it for salary payments and also payments to suppliers and others. But MSMEs are still lagging far behind for the adoption of fintech use. So this could be one important policy issues aspect for the government to ask them or to give them incentive to use like textile firms to use the mobile financial techniques that more services so that they can get more quick recovery of their losses. So with that, I want to finish. Thank you so much.
Okay, thanks very much for a very interesting presentation. So the discussant is Dr. Asami Takeda, who's project consultant at ADBI. So Takeda-san, you have 10 minutes. The floor is yours.
Okay, thank you, Peter-san, and thank you, Hossain-san, for presenting the interesting results. So I will share my presentation slides first. So can you see the slides, and then can you hear me clearly?
Yes.
Okay.
Yes, on both.
Thank you very much. So I would like to share some comments on the paper. So first,
please switch to full screen mode.
Oh, okay. Is this okay?
Not yet. Yeah, that's fine. That's fine now.
Okay, so first, just a quick summary of the paper. So the aim of the paper is to assess the impact of the COVID-19 pandemic on micro, small and medium enterprise, and then the role of the fintech. Here it's defined as the mobile financial service and then online platform in their recovery stage in Bangladesh. And I think that this paper addresses very important and timely issues since micro, small, and then medium-sized enterprise play very important role in the economy in Bangladesh, which applies to almost all developing countries. And our interest is how they can recover from the current COVID-19 pandemic. And the study uses the data from a survey of the 200 MSMEs from the Bangladesh small and cottage industry corporation, and the results are based on 153 firms. And there are mainly three findings. So first, the use of the fintech significantly contributes to the recovery of the firms in terms of production and sales. And second, the use of the online platform did not contribute to the recovery. And finally, recovery is significantly higher for the firms that have a higher skilled labor. And now I would like to make a comparison of the result of the descriptive analysis in terms of the digitalization with the ADBI survey. So among the 153 MSMEs data used in this paper, 23% used the mobile financial service, which is equivalent to the 35 firms, and then 40% had e-commerce websites, namely 21 firms. And ADBI is also conducting the SME survey with the ASEAN Productivity Organization in 8 ASEAN countries, including the Bangladesh. And we just finished collecting the second round of survey data. And we have a larger sample size, a total number of the valid responses over 2,500. And the number of valid responses in Bangladesh is 300. And we also collect information on the digitalization. And the upper figure shows the proportion of firms using the digital payments, namely a use of the digital wallet and then online payments such as a PayPay or mobile payments. And the proportion is in our sample in Bangladesh is 21%, so which is almost the same as the 23% in the paper. And below figure shows the proportion of firms that had online sales in 2019, which is 7% in ADBI survey in Bangladesh, and which is similar to the 10% in the paper. And our survey shows that the digitalization in Bangladesh is lagging behind compared to the other ASEAN countries. And from here, I would like to comment mainly on empirical analysis. So first, I would like to comment on the representativeness of the sample firms. The paper based on the survey of the 153 firms from the Bangladesh small and cottage industry population. And I just would like to know how much proportion of the SMEs in Bangladesh are members of the BSCIC, and are there any difference among the firms between member and then non-members? I'm asking this because we are facing the same issues. So SMEs in our sample have a connection with the NPO in their country, and our sample is unlikely to represent the ordinary SME. So I would like to know how you cope with the selection bias issue, if any. And furthermore, I would like to know the structure of the industry. So I mean, how much percentage of the sample firms belong to a textile, food industry, and so on. And during your presentation, I think you said a proportion of the firms experienced the decrease of their production was 50%. And this implies 50% of the firms continues their production even during the lockdown. So I would like to know which industries were allowed to operate during the lockdown in Bangladesh. And I guess it might be a textile and food industry, but I want to know such kind of the information. And next, estimation strategy. So dependent variables are the rate of the recovery between the lockdown, which is April and May, and recovery period, which is the third quarter of the 2020. So in terms of the production and sales and then the profits. So first point that I would like to know, if there are any change between the period from lockdown in April, May to the third quarter of the 2020. I think in such a short period, I suspect there is almost no change for the almost all the control variables, such as like a ratio of the skilled labor and so on. Next, the point is like a sample size. So the number of the firms use the financial service in their business is like only 35 firms out of the 150. And I'm wondering this is enough or not. And I didn't know that you presented the result of the e-commerce, but I'd like to know the reason why like e-commerce dummy is like a negative significant, which I saw the slides that I received. And I also would like to know if there are like any governmental support which affects the recovery of the firms, such as like a tax exemption or wage support to the employees and so on. And next, it would be like a better to add more control variables such as like a gender of the owners or the percentage of the export out of sales if data are available. And next, the final slide. So the study presented the IB regulation results to cope with the end-of-the-90 issue of adoption of the mobile financial service. And I think the study used the distance to district and it's were termed as the instrumental variable. So, and then the results show that the coefficient of the fintech is like a positive and significant in terms of the production recovery, which I remember. So the IP regulation results was only presented in terms of the production. So I'm wondering what could be the result with the dependent variables like sales and then profit recovery. And more importantly, the instrumental variable should satisfy the two conditions. So first is the relevance, and then the second is like exclusion restriction. So the relevance condition is like that instrumental variables are correlated with the endogenous variable, which is like a fintech dummy. So I think we cannot judge the proposed instrument or appropriate or not based on the information during the presentation. So I think it's better to show the like a first stage regression results or if statistic which should be greater than 10. And the second is like exclusion restriction. So the instrumental variable has no correlation with the error term. So it might be better to show the result of the like a Hansen J over identification test, or it's better to provide like a more plausible explanation about the instrument. And then if data are available, I'm not sure you already used this or not, but I think it would be better to use the distance to mobile like a mobile money agent instead of the distance to district, since it is more relevant to the adoption of the mobile financial service. And finally, suggestion for the future research. First, it might be interesting to identify the determinants of the fintech use, but I think you already presented during your presentation. And second, I think the data related to the employment are also available in your data. So I would like to suggest to investigate the relationship like between employment and fintech. So it might be interesting to see whether the fintech save labor or the create more jobs. And finally, I'm looking forward to seeing the accurate results with more sample size. Thank you very much.
Okay, thanks very much. Mansoor, would you like to respond to Takeda-san's comments?
Yeah, thank you, Takeda-san. It was very interesting comments, and I agree fully on almost all the issues with you. First of all, just as you asked about whether the firms in this stage are different from other firms, I think there are some differences definitely because they are within enclaves, and so as we know that agglomeration, they might enjoy the benefits of agglomeration economies, but Considering all other things, I don't think that they are enjoying that much, but still, since they are using some service land and other facilities, networking facilities, they are in a better position to some extent. But I am very glad to see that your farm surveys proportion and my one is almost consistent. So I am a bit happy to see that kind of thing. About the IV regression diagnostic test, I think we have done so, and the satisfied Hansen test and others satisfied the validity of instruments. So it's okay so far. And as you already seen, we have also used the mobile distance to mobile agent that are very common in this literature, and also the number of agents in the vicinity of the farms or estates that were also used. But the question you asked, whether the number of farms is enough to run this regression or others, at least we got some sense, I think, about this. As you see in your survey, bigger survey, and also our smaller survey, the proportion is almost the same, about 21% or 22%. So I think this is important. And also, as you said, whether there is any incentive or yes, for the textile farm in the farms, there was a stimulus subsidized credit for the farms government offered during the lockdown, but there was a condition to use the mobile financial service to disburse the payment to salaries of the workers, so that they don't face any face-to-face problems, or they don't need to go to bank or other places. So that was one incentive to use this mobile financial service and to stay in their production process. And as you already mentioned, as you have seen, we have already run a regression on the determinants of mobile fintech use. That was a big question at the moment, why some are using and some are not using. As you have seen that, I think COVID prompted many farms to use this kind of technology that is also evident in other studies worldwide. I think our results are consistent. And I also agree with your other suggestion, whether we can see the change in employment and other things, whether that was saved, employment was saved by use of this kind of technology, financial technologies, so that they maintain their production process and others. With all this, I think I thank you so much for your nice comments. Would love to see if you can share your slides with us.
Okay, thank you very much.
Yeah.
Okay, we have one question from the floor. Mohammed Majiful Islam says, digitalization is adding some values to its sophisticated clients and users, but in the contrary, it is narrowing the access of rural people to banking activities. You know, ICT infrastructure has not been developed in that manner to practice contactless banking in those rural areas of Asian countries, also in some developing countries of other continents. Moreover, a lion part of people are lacking technological know-how as to adapt themselves in such contactless banking. So my question is, are we not narrowing the access of banking activities to people, especially in the rural areas?
My answer is no. The reason is that in Bangladesh, still in rural people are, most of them unbanked people, they are deprived of getting the access to banks, particularly for commercial banks and others, because they are not opening up their branches or expanding their branches in a viable manner. So in that case, I think agent banking or other type of fintechs have leverage to provide some services to the rural people also. Even as you see in Bangladesh, the mobile financial service has a great stride in expansion, and most of I think many people are using this, and their expansion is very rapid over time. So I don't see any, I think, contrasting scenarios between formal banking and digital financing, because digital financing are I think making up the limitations of formal banking to some extent. I think Peter would say he has been working on this for a long time. You can say a bit more about this.
Yes. Okay, question from Paul Vandenberg. Paul?
Yes, hi. Again, thank you for a very interesting presentation and some sort of real life on the ground data. I think it's very interesting. Just a couple of questions. One is, you know, the use of fintech in your study around 20% seems kind of low. Is that partly because you're dealing mostly with production firms in these estates, and that if you you know, if your sample included more sort of retail and as sales firms, that your numbers would be higher. I just wonder that. I mean, in particular, I think it said that e-commerce sales were increased, only 8% of them increased their sales. So is your sample a certain type of firm that maybe doesn't use e-commerce or fintech as much? I don't know, that's one of my questions. And then my bigger question was, I saw from your results, if I understand correctly, that the people who used, the firms that used fintech had used it more during COVID. I think that's the basic result. But the bigger question, I think, is, did it prompt any firms to adopt fintech or not? I mean, did they see this as an opportunity or as a push to adopt fintech, as opposed to just talking about the ones who already had it and then sort of increase their use? My final question really is, was there anything that surprised you? I always think that's one of the interesting things when we do research. We do a survey, we get some results. Is there anything that surprised you, you didn't think would be there, or it wasn't there that you thought should be there, and so on? Thank you.
Okay. Thank you, Paul. First of all, definitely there is a difference in our firm. They are all manufacturing firms. We did not consider the trading firms or service firms. So they are more on a production process. So that was our main goal. So that's why you might see a bit lower proportion of e-commerce and other sites. So still, it is interesting to see that a few firms are using this online platform and others. So the second question you said about adoption and sustainability, I think since COVID has been continuing over time, since firms have been finding this more as a more important mode of transaction that help them to recover quickly or maintain their production process and supply chain network and others, I think they might continue. And since the firms we are considering are in a state farms in enclave, so perhaps networking, if it works, it might have a spillover impact on other firms too. Hopefully, maybe another survey in the next year, this year, might give us more answer about this. Finally, you said that what surprised me, I think the positive impact of MFS on recovery surprised me a lot. So how it has happened, why it is coming very significant in every analysis, that was surprising to me. But in the end, I am not very surprised in the sense that they are using these services very judiciously and definitely in an effective way. That's why their production process, they make up or recover their production process at a faster rate than others. So I think this is the main answer.
Okay, thanks very much. Well, we're just out of time. And I think we've had some very interesting papers and good discussions. So let me, please join me in thanking the presenters and discussants. And let me close the session here and turn back to John.
Thank you.
Thank you, Peter.
Thank you very much, Peter. And thank you for the presenters and discussants in that paper session. We will now move to the final session of the conference, in fact, which is a keynote speech by Douglas Arner and Bihong Huang, who's a former colleague here at ADBI, who's now an economist at the IMF, will be chair of this session. So I now hand the floor to Bihong. Go ahead, Bihong.
Thanks very much, John, for inviting me to attend this wonderful workshop, and also great to see all our former colleagues. ADBI has been very active in terms of promoting fintech research and also policy dialogue. And all the presentations I listened this morning are excellent. Congratulations, John and the Institute, for very successful workshop. Now let me briefly introduce our keynote speaker, Professor Douglas Anna. He is actually the Carey Holding Professor in Law at the University of Hong Kong, and he specialized in economic and financial law, regulation, and development. He was an inaugural member of the Hong Kong Financial Service Development Council. He is co-founder and a member of the Executive Committee of the Asia Pacific Structured Finance Association, and a member of the advisory boards of Supercharger Fintech Accelerator, the International RegTech Association, and the Center for Finance, Technology, and Entrepreneurship. And actually, I was the student of your online course, Introduction to FinTech, several years ago when I started to do research in the FinTech. I looked for the online courses, and fortunately, I found your course. It was excellent because I found that your courses not only teach like technical issues of FinTech, but you give a very good background, history, also logic of FinTech, I mean, from the history of finance and monetary. So I really learned a lot from your online course. So today I'm very much looking forward to your lecture. The floor is yours, please.
Thank you very much for that, Bihong, and really appreciate the remarks on the course in particular. I'm really glad that you liked it. That's been something I think really exciting since we came out with it. The response, the sort of take up globally has been just way over what we anticipated. I think we've just crossed over. We've got about 90,000 people that have done it or are doing it. And I think at this stage, we have people in every country in the world except one. I need someone in North Korea to take my course. And I know the chances are not good, but if I can get a North Korean, that would be 100% of countries in the world. So no, thank you very much. And thanks to John and the whole team at ADBI for the invitation to be here, but also for putting this together. I wasn't able to join the first 2 days, but like Bihong, I very much enjoyed the discussion so far today. And I think some of the things that I'm going to say very much reinforce, follow on, build many of those comments. I guess I should say as well that, there are many things that I think all of us have found with online sort of interactions and events, that there are many good things about them in terms of outreach, participation, lack of jet lag. But this is exactly the sort of event that I really miss being in person. Because if you think about a 3-day event, lots of people that I've known speaking at the past 3 days, but also lots of people that I don't know. And lots of interesting papers. And it's exactly the sort of event where if you were there in person, you would have the opportunity to meet many of those people that you didn't already know, and to have the opportunity to basically talk after having heard their presentation, which always gives you a trigger. I find online works really well with people you already know. If you already know people, it's very easy to sort of interact, but it's much more difficult to build connections when you don't. And so this, I think so far has been a great event, but it is exactly the sort of event that hopefully maybe this time next year, we can actually be doing these sorts of things in person again. I'm going to bring up a few slides. And the slides basically talk about this theme, COVID-19, digital finance, financial inclusion, and sustainable development. And I think one of the big themes coming out of COVID is something that we've already heard today, which is the role of digital financial infrastructure in actually managing crises like COVID-19. But also thinking about how we can use this experience to try to build better financial systems. And much of this is joint work, and we'll also get some discussion of a paper of ongoing work from my colleagues Dirk Zetsche and Ross Buckley. Now, I think one thing that I do is I take a very broad view of digital finance or fintech. Basically, when I'm talking about fintech or digital finance, I'm talking about use of technology in the financial services sector. And as Bihong mentioned, in the context of the online course, this is something that we talk a great deal about, that if you look at finance and technology, they have been co-developmental across really 12,000 years of the history of settled human civilizations. But I think certainly over the past 50 years, we've seen a dramatic increase in technological development and a process of digitization and datafication that has really transformed the way that financial services operate increasingly all over the world. And I think if we look back at the last 10 years, where we saw many rapid developments, we can say that certainly the 2008 crisis was a defining feature of the last 10 years. Much of that crisis expressed in regulatory changes that have cascaded throughout financial systems and the financial industry around the world, but also technologies. And I think that much of the past 10 years was sort of about new technologies. One often talks about ABCD, sort of the idea of AI, of big data, of cloud, of distributed ledger technology, and how these new technologies and a bunch of new startups and new entrants could disrupt, change the way things were being done. And it's something that we spent a lot of the last 10 years talking about, not just in developed markets, but at all levels of developing country experience. And I think if we're coming out, and even before COVID, we were already highlighting that if we were looking at themes for the 2020s, we were suggesting sustainability. And I think this is something that even a year ago was already being picked up. But COVID-19, which we describe as an existential sustainability crisis, has driven this to, I think, a much broader consensus, both from the standpoint of facing COVID itself, but also thinking about the fact of other sorts of sustainability crises, particularly around climate, but also other health issues, and how we can use the experiences of COVID-19 to build better financial systems. Second, technology, I think, in the 2020s is something very different. And many of our discussions, particularly when we think about some of the India discussions or others, highlight this. And I think probably a transformational moment in the history of finance and technology, and certainly in monetary history, took place in mid-2019 when Facebook announced its plan to create a private global digital cryptocurrency, Libra. And essentially, that announcement highlighted the potential of technology and finance, not from the standpoint of new startups coming in and disrupting things, but from the standpoint of major developments which could fundamentally change the way that everything was being done in financial services. And I think increasingly, as we look at technology, not just in finance, but also generally across economies and societies across the next decade, we're going to be faced with these bigger technological issues. And of course, something that was already building, but has, I think, is likely to be a growing theme going forward, and that is tensions between processes of globalization and fragmentation. Now, if we look at COVID-19, I think the first thing that is really important to mention or to highlight is that COVID-19 has not been, in most places, a financial crisis. That means it's a very different experience from 2008. If anything, what we've seen today has been that finance has been part of the solution to problems as opposed to the cause of those problems. And even if we think about turmoil in global markets of March of last year, the reality is that, yeah, there were some challenges, but nothing fell apart. And if we look at 2020 as a stress test of the global financial system, it did remarkably well. And a lot of that, of course, can be tacked back to those post-crisis regulatory changes over the past decade. And I think if we are thinking about COVID-19 and we're thinking about one aspect that has been driven forward particularly, that has been digital finance. And many of our discussions today have been about the positive role that digital finance has been able to play. And I think one thing that many of us are increasingly recognizing is that 2020, in a year's time, in the context of digitization generally, but particularly in the context of digital finance, has probably driven 5 to 10 years of development that we otherwise would have expected this to see. And I think if one is looking at the direct impact, and many of our sort of more quantitative analyses from other colleagues throughout the day have picked up on different pieces of these, highlighting what we are seeing. And what we summarize are the sort of big picture trends. One area has, of course, been around digital payments. Another has been around the use of technology for regulatory and supervisory purposes. A third has been all around non-face-to-face issues and rethinking approaches to AML and market integrity. And the fourth is really one of our biggest, I think, policy challenges and questions going forward over the next decade, and that is concentrations of data and how we go about using data to support our societies, but also balancing the risks that come with digitization and data concentration. And I think if we think about the payments context, this is something where those markets where there was availability of interoperable electronic payment systems, particularly coupled with wide-scale availability of accounts of any sort, whether they were mobile wallets, mobile money, bank accounts, any sort of account, that this has been a very powerful tool. And that places like the United States, which didn't have that, have found it more of a challenge in the context of delivering financial resources. Digital payments, not only from the standpoint of crisis responses, enabling life in the context of lockdowns, supporting e-commerce. And of course, what this is also driving, particularly in the aftermath of the Libra announcement in 2019, are thoughts particularly from central banks, about how can one go about building better systems. And perhaps the biggest example of this has been the development and large-scale piloting of the central bank digital currency in China, DCEP, the Digital Currency Electronic Payment System. And this is something that many countries around the region and around the world are looking at similar sorts of issues. And of course, at the global level, the G20 last year commenced a process whereby essentially they're trying to look at technology, the ideas underlying Libra in particular, and how the technology could be used to address many of the issues that we have in cross-border payments, particularly questions around efficiency, but also balancing challenges between risks and inclusion, the real de-risking problem. If we think about RegTech and SupTech, what is this? This is the idea, and once again, I take a broad approach to this. This is the idea of using technology for regulatory compliance, as well as supervisory monitoring and systems development. And certainly something that we have seen all over the world has once again been, in just a year's time, probably 5-10 years worth of development, for the simple fact that if you think about regulators and you think about the role of on-site supervision in financial regulation and supervision, that has been unavailable pretty much everywhere for the past year. So those traditional face-to-face interactions between supervisors and industry participants have had to go online. That has meant that there has had to be a greater comfort in terms of particularly digital reporting, but also interaction. Second, if we think about regulators, central banks, supervisors themselves, they have obviously had to go online, working from home, dealing with their own arrangements. And of course, discussions like this, where discussions across regulators globally have all been online since really this time last year, driving a much greater level of comfort with non-face-to-face processes. And of course, from the standpoint of industry participants not being able to have employees in the office in many cases, or having to deal with non-face-to-face interactions with customers, with regulators, with compliance staff, with operations staff. All of this has been a huge transformation, and certainly one area, in addition just to the simple comfort aspect, has been movements to cloud and other sorts of services by financial industry participants, regulators all over the world. The third aspect has very much been about AML and market integrity. And this is something that has been a big challenge in developing countries for a huge range of reasons. And of course, Bangladesh central bank heist in 2016 raised this to an entirely new level. And COVID has driven some discussions in a much different direction. And that has been the recognition by the FATF, the Financial Action Task Force on Money Laundering, that not only is a digital identification, particularly a sovereign biometric digital identification system, not only is that as good as a paper-based identification system, but in fact, it may be better than a paper-based identification system. And that simple recognition is beginning to allow us to think about designing AML systems in a different way, as opposed to focusing on the financial industry as gatekeepers, rather focusing on data analytics at the regulatory level in order to be able to derive patterns, not just within single institutions, but across institutions and potentially across economies, to actually develop systems that not only are less costly from the standpoint of compliance, but actually they're much more effective from the standpoint of achieving regulatory objectives. And that is RegTech building systems. All of this comes at the cost of what we call tech risks, which are the risks of digitization. And one of the biggest of those is around concentration. And this is something that we're seeing emerging as a major discussion issue really all over the world, is how do you balance the benefits between concentration of data or access to data and concentration in terms of market dominance and its potential impact on things like competition and innovation. All of this is saying that in addition to recognizing the importance of digital finance from the standpoint of managing the crisis, we're also thinking about ways in which we can build better financial systems. And I think some work that we had done with the Alliance for Financial Inclusion pre-COVID, essentially what we did is we were asked by AFI to look at how technology, how fintech, how digital finance could be used to support financial inclusion. And essentially what we did is we looked not at, in the most recent Findex, the 1.7 billion people who didn't have access. Instead, we looked at, from the first Findex to the most recent Findex, the 1.3 billion who had gotten access. And we asked, were there big stories in that access? And we found that there were really 4 countries where we had seen the biggest changes, accounting for the vast majority of that 1.3 billion. That was China, which has seen the most comprehensive digital financial transformation of any economy in history. It was Kenya with M-Pesa. It was Russia on the basis of essentially expanding financial services via mobile systems. And it was India on the basis of the India Stack strategy, which has already been discussed. Essentially, what we identified was a focus on digital access, particularly mobile penetration, on digital identification, particularly sovereign biometric digital identification systems, simplified account opening systems to maximize account access, interoperable electronic payments. And essentially the fact that this framework not only gives you access, but it gives you use. And importantly, when this is combined with the government using it for delivery of payments and services, that this has a big impact from the standpoint of thinking about financial inclusion, not just from the standpoint of having an account, but financial inclusion from the standpoint of wider developmental impact. And so coming into COVID, I think a big question, and we saw that where countries had in place these sorts of frameworks, they have been able to use them quite effectively. Coming out, we are seeing that essentially the opportunity is there to use a similar sort of strategy from the standpoint of building financial systems. And as I said, we are always looking at this from the standpoint of wider sustainability indicators. And of course, the first framework was looking just at financial inclusion. Then we see this impact in the context of COVID, where essentially this sort of system is important in responding to the crisis. And if we begin to think about the aspect of COVID, of trying to think about how can we build better systems for both resilience in the face of future crises, whether COVID or otherwise, and at the same time, from the standpoint of trying to lay the groundwork for better sustainability, we've now been looking at the question of wider impact. And essentially, we're seeing that this combination is useful in a crisis, which are many of the stories that we've seen today, but also that there is a correlation between savings outcomes. And if we are able to generate additional savings, that is one way to address to provide potential additional resources from the standpoint of sustainability, but also from the standpoint of looking at individual sustainable development indicators. And essentially what we're finding is a correlation, so far just a correlation, between essentially the combination, particularly mobile access, digital ID, interoperable payment systems, and SDG outcomes. So,
sorry, Professor Douglas, could you wrap up because we are a little bit behind the schedule?
Yep, I'm wrapping up right now.
Okay, thanks.
So, from the standpoint of systems design, I think the key lesson that we can take away is that one, digital finance played a very important role in responding to COVID-19. Digital finance provided an important mechanism whereby financial systems worked to support other activities. Second, COVID-19 is not only driving digitization of finance, but countries are looking at how can they build better systems. And increasingly where we are focusing is this combination of digital access, digital ID, particularly sovereign biometric government IDs, simplified account opening processes, interoperable electronic payment systems as a set of rails for provision of a wide range of different government services. But at the same time, as has already been discussed today, this framework, this set of rails, reduces the cost of customer acquisition, which enables new business models, new entrants, which support wider development. Now, I think the challenge going forward around all of this and happy to discuss these in more detail, is around last mile, particularly last mile digital access. And second, around the potential risks of having these sorts of data concentrations in government or private sector, and how one can think about balancing the approach, the benefits, with some of the risks. Thank you all very much.
Thanks very much, Professor Douglas. Very comprehensive and insightful presentation. You actually give us a very exciting picture about the future of finance and also fintech, and also how the technology could be used to solve a lot of issues our societies are facing. Now let me open the floor for discussion. Or maybe we can start from the questions put on the Q&A.
I can have a question first.
Okay,
In the meantime. Thanks, Douglas, for an excellent presentation. I'd just like to ask a question about this issue of regulation and regulatory uncertainty. And is this something that is more pervasive for economies that are more technologically advanced, rather than those that are less technologically advanced, which may be facing issues around literacy more so, rather than regulatory uncertainty? So the question is, are countries that are less technologically advanced also facing risks related to regulatory uncertainty?
Yeah, I think there are definitely issues. And if we look at this sort of overall strategy, one which I've really focused on today is at the infrastructure level. The second is around regulatory approaches to innovation and technology. And the third is really around wider ecosystem sorts of issues. And I think from the regulatory standpoint, we've seen a variety of different approaches. There's discussions about whether you should not regulate things for an extended period of time, or whether you should put in place clear frameworks. I think the Chinese experience is highlighting that there are, at some point, you're going to need to build a regulatory framework to deal with something. And that at some point, if you don't regulate non-traditional finance and traditional finance in the same way, what you end up with is unfair competition, regulatory arbitrage, and the sorts of risks that we're all very familiar with. And so I think the key point here is that often when we are talking about the developing country context, the first stage is the infrastructure. That what we're often finding is that the biggest problem, the missing bit, is infrastructure. The second, though, is that often, as has kind of come out of some of these other discussions, the entry point is around payments. And so from the standpoint of payments, really the first stage is to recognize that payments regulation is something that fits perfectly between central banks or regulators' monetary stability and financial stability mandate, and that if there isn't a regulatory mandate to regulate payment systems, that's something that's needed. And probably in most cases, what we're seeing first is the need for some sort of licensing framework, just simple. And we argue for what we call a graduated proportional approach, which basically says the smaller you are, the less risky and the less regulatory requirements you should have. The bigger you get, as you move from a small payments company up to being M-Pesa or Alipay, the bigger you get, then the more risks you bring and the more regulatory scrutiny you need to have. And I think the key there is, one, to recognize that often it's payments are the entry point, and to keep a focus on that, particularly because it matches very well with central bank and regulatory mandates. And second, to keep in mind this idea of a graduated proportional approach. I think it's probably not appropriate to think about how can you build an entire regulatory system at the very beginning, because almost no one has that right now. But payments, that's usually the starting point.
Okay, thank you.
Thanks very much, Professor Douglas. Yeah, you use China as an interesting case to illustrate John's question. And actually, we note that like in recent year, actually the Chinese government has been implement more and more regulation. First start from Alibaba, and then if we can follow the regulation process, I believe for a lot of countries actually they can, how to gradually increase the stringency of the regulation. And we have a couple of questions from the Q&A box. I think it's mainly about the consumer protection. On one hand, yes, technology provides us a lot of convenience for access the financial services, and at the same time, currently, like cybersecurity issue has become more and more important. Could you share your view about this?
Yeah, I'm gonna highlight this from really three different angles, and the three questions. One is really around financial crime, and I think that a corollary that we've seen everywhere in the world is that with digitization of finance, has been a pretty dramatic expansion of digital financial crime of all different forms, particularly preying on those that are already disadvantaged from the standpoint of financial literacy or otherwise. And what I think this highlights is a very important need from the standpoint of regulators to not just focus in on, for instance, their narrow mandate of the banks, but rather to be looking very broadly at the things that are happening. Because of course, with social media, things in our framework can develop from too small to care, to too large to ignore, to too big to fail in record amounts of time. And so it's very important, I think, to one, as has been discussed earlier, highlight digital literacy efforts. Second, for supervisors to think about their own data collection efforts. So that's on the crime side, and to realize that from the standpoint of police forces in many places need to be thinking about the reality that they are going to face more and more digital crime and need the resources accordingly. The second is really around cyber risks. And this, I think, is a huge issue for everyone from a financial risk standpoint, from a financial stability risk standpoint. And this is something where we're seeing more attention, but I think that this is something where we need even more attention, particularly as our dependence on digital financial infrastructure continues to increase. These risks are not getting easier, they're getting bigger. And finally, this point, what should be the priorities of developing countries in terms of infrastructures, building better financial systems? I think one thing that's really important is that the cases where we've seen the biggest examples of leapfrogging really have been those where the traditional financial system isn't working very well. If your traditional financial system works okay, it doesn't have to work great, but if it works okay, there's less of a necessity to sidestep it. And many of our greatest successes have been where the existing system didn't work very well. For instance, China's financial system in getting financial resources to small and medium-sized enterprises. It wasn't very effective at that. And so digital finance was allowed to develop, and it was very effective at doing that. And so that, I think, is the key, is thinking about the opportunities. And I think if we're thinking about where do you get your biggest impact, a lot of it is around digital access. And that is really, as a starting point, about mobile penetration. And I think some recent experiences in India and elsewhere have highlighted new approaches from the standpoint of mobile phone access and the importance of data from the standpoint of business models that can in turn subsidize handsets and or towers and other sorts of infrastructure development. From the standpoint of governments, digital ID is tremendously powerful, and there are massive projects around the world looking at national identification systems. We think back to Hernando de Soto or all sorts of other works about the challenges of informal economies, informal finance. One of the biggest is people not having formal identity. And the reality, as Aadhaar has shown, is that a digital system is actually a whole lot easier to deploy than a paper-based system. But this is something that is often outside of the scope of the financial regulatory authorities. From the standpoint of financial regulatory authorities, often I think the biggest impact is from the standpoint of thinking about interoperability of payment systems. In other words, payments get their biggest impact from network effects, the ability to get payments from one end of the economy to the other. And many companies have tried to build ecosystems. Ecosystems, walled gardens, means that payments don't go in and out. What can a government do to make interoperability happen? To make it a licensing condition, to build a switch that allows different systems to actually interoperate across one another, building a national fast payment system or RTGS system. Or if we look at more recent examples, discussions around how could one build a central bank digital currency that would address interoperability issues. So I think from the standpoint of biggest bang, from a financial regulatory standpoint, it's around interoperability of payments, new entry of payments. From the standpoint of biggest impact, generally, it's digital access combined with digital IDs.
Okay, thank you very much, Professor Douglas. Yeah, I think we have very excellent presentation and discussion. Due to time constraint, let me again thanks for the presenter and also the discussion, and then conclude this session. And I will hand back to John.
Thank you, Byung, and thank you, Douglas, for a very interesting and thought-provoking speech, and also your following remarks. We're now at the very final stage, and this will be some closing remarks by Dean Tetsushi Sonobe of ADBI.
Hi, John. Thank you.
Thank you, Dean.
So it came too early for me. I'm not really ready. Yeah, but let me start. Yeah, thank you very much for everyone for the great presentations and discussions. Where is my memo? Yeah, it is. So yeah, over the last 3 days, yeah, we've been really immersed in fintech and COVID-19. Yes, very intensive, series of stimulations, to me at least. And yeah, for me, this was really eye-opening and enlightening. And then I think the world has been already immersed in the great digital transformation in the past 2 decades, as manifested by the disruptions caused by new big tech business models. But as we have confirmed repeatedly over these 3 days, COVID-19 provided a major boost for digital transformation of economies across the world. Yeah, so because of the great lockdown, we have had dire consequences, but digital technology came to help, and we observed that the accelerated use of e-commerce and digital payment during COVID-19. And then the people have learned the benefit of using those new technologies and the new services. So there has been a learning by doing, so which implies even larger and enduring impacts and effects of these transformation. And for example, the central bank digital currency has climbed up in priority. Against this backdrop, we have discussed various issues related to fintech, which seems to have some clusters. I'm not sure exactly how many clusters of issues, but there seem to be at least 3 clusters. The first is I think, characterized by the keyword data or data sharing. The second cluster of issues is characterized by the keyword financial inclusion. And the third cluster of issues is about constraints and the risks in the way forward. Yes, so about data and data sharing. Yes, this 3-day conference started with a keynote speech by Professor Jin-Chuan Duan. He talked about MSMEs finance And then according to him, but also almost everybody knows that MSMEs facing challenges, financial challenges, such as higher rejection rate than larger firms. This happens because banks have higher transaction cost or information cost when they deal with smaller firms than larger firms. So the professor emphasized that that's source of the problem, and then because of this disadvantage, small businesses are receiving the kind of subsidies or during the COVID-19, but it may not be the real solution because such government supports do not solve the fundamental problem of information asymmetry. Who is a good borrower, who is bad borrower. So he's he proposed the new models of sharing data about the borrower's characteristics or attributes. And then later in the same day, we heard from Professor Pinar Ozkan about the great development of open banking, which is essentially the sharing of data and then kind of disclosure of data to those fintech firms. Yes, so that kind of issues is one. And then financial inclusion is another cluster, as I said. And then we had a lot of interesting arguments, especially today. For example, the Ratona argued about the close relationship between financial inclusion and the economic growth, financial inclusion and the inequality, financial inclusion and the gender equality, and so on. And then this issue has been repeated, and then also even the central bank digital currency is becoming popular because of the promise of financial inclusion. So this is the second cluster, and the third cluster of topic or issue is about the constraint and risks, like technical constraint or technical risks about data, or cyber, or infrastructure, or governance issues, or financial stability, or regulatory difficulties, or even the digital exclusion due to the lack of digital literacy or lack of infrastructure, digital infrastructure, and also biases in historical data, because data are used to distinguish the good borrower and bad borrower. So we are will be labeled, and then there may be bias in historical data, and then that may be another. Of course, there is a big issue of data privacy. So we have been discussing these issues, and then all those presentations have been very, very interesting, and then very informative and useful. So I'd like to congratulate all the speakers and the discussants, and thank you very much for moderators for their great jobs. And so finally, I'd like to add the one advertisement. Let me check. Maybe this may be better to announce by Peter, but no, let me try. So ADBI will join the on May 28, 29 this year, joined the Xi'an Jiao Tong Liverpool University in the 8th seminar on Asia and Pacific economies. And the ADBI, we sponsor particular sessions about financial inclusion and financial literacy, financial regulation, and also SME finance, as well as infrastructure development. So I hope these sessions at least will be open one. Peter, are you here, or John? Am I correct? Is this open to everyone?
I'm not sure if it is, but normally they are open to the public. Yes, we'll have to check for sure, but yes.
Yes, it's not a capacity building and training program, so it should be open.
I assume so, yes.
Yes, so please pencil in, so at least check somewhere that we, ADBI, we're going to have the sessions on these issues, which must be very interesting for you. Okay, with this, I'd like to stop, and then thank you very much again. And I think this 3-day virtual conference has been a great success. Thank you. Back to John.
Thank you very much, Dean Sonobe. So we have now come to the end of the conference. So I would like to thank all of the speakers. I think we have learned a lot and stimulated a range of different ideas for future research. In terms of the outputs, all of the material that was presented, including the video, will appear on our webpage, so the webpage for the conference, over the next couple of days. In terms of further outputs, the papers that were presented will be considered for publication in the ADBI Working Paper series, as well as a book on the conference topic at a later stage. So I would once again like to thank everybody for your excellent contributions, and the conference is now officially closed. Thank you very much.